There we go. So with that, I am going to hand it over to Dr. Frayne Olson. Frayne, if you want to take it away, like I said, we will pause for questions, or you can use that chat function and I'll keep an eye on that.
All right, very good. Thank you, Jenna. Let me share my screen. Click here. Share. All right. I'm just going to double check that is showing up okay. Is that all right, Jenna?
Yep, it looks good
All
on
right,
my end.
perfect. Perfect. Okay, so good morning, everybody. I appreciate the invitation and your participation in today's webinar. Hopefully you will find this valuable. So as Jenna said, I'm Frayne Olson. I work as a crop economist and marketing specialist here at NDSU Extension. If you do have some questions or things that come up, please put them in the chat box. I'd rather try and answer them today and get them out of the way. If there are some things later on that come up that you have questions or concerns about, feel free to reach out to me. Here's my contact information, my email, as well as my phone numbers. I guess as a recommendation, the cell phone number is probably the most reliable because I do have a pretty heavy travel schedule coming up, even this fall now. So cell phone probably works the best as most reliable. So let's just dive right in. We're going to talk about, I want to set the stage here in a little bit. And even though we're going to talk a lot about soybeans, and that's really the focus of the session today, I am going to make a couple comments about corn because of the interaction that we see in all the markets from a pricing standpoint. What happens in the corn market usually spills over into soybeans, and what happens in the soybeans often spills over into the corn market. So I just wanted to give people a little bit of a refresher on why that happens. And so we can't just look at soybeans in total isolation. What happens in the oilseed complex is actually very complex. There's a lot of interactions, a lot of things going on. So I just wanted to remind everybody as we think about supply and demand. This first session is about the production and consumption. On the production side, planted acreage and now the estimates for harvested acreage were up a little bit from last year. We expected to see a shift away from corn and into soybeans nationally. We did get that simply because the corn acreage was so high last year. So we're kind of coming back to more of a normal relationship. So the gold line on top is corn, the green line is soybeans, the dotted line is the current numbers or current forecasts, primarily coming out of USDA, just to give people a reference point and a refresher. Now, when we look at bushels produced, so those are acres planted. When we look at bushels produced, again, the gold line is corn, primarily for grain. Now we're counting bushels of corn. We're not talking about corn silage. And then the green line, of course, is soybeans. Dotted line is the current USDA forecast from the July WASDE, or the World Agricultural Supply Demand Estimates. I'm going to talk about that in more detail in a moment. So again, just to put things in context, to put things in a framework, a reference points, if you will, to say where are we today versus where we were last year. Again, we're looking at right now, we'll get an update on Monday, but right now we're looking at a slight decrease in corn bushels produced and a slight increase in soybean bushels produced nationally. Okay, and so when we think about what's going to impact prices, is it going to be a supply side shock? Is it going to be demand side shock? What do we know what's going on in the market today versus what we expect to happen in the near future? And those are the things I'm going to be talking about. But just to put things in context, historical context, to say where are we today relative to where we have been the last several years. So let's dive right in. Don't worry, I'm not going to go through all of these numbers. In some of my longer presentations, I do kind of dissect some of these numbers a little bit more detailed. So this is the USDA information. We usually use that as the benchmark. The way I describe it and remind everybody is, if you're listening to the radio or reading a market report or some kind of analyst analysis of what's happening in the marketplace, oftentimes they'll quote the USDA number. It's like, well, USDA is saying this, and here's why I think they're wrong. And so if you don't understand what that baseline point is, you don't that anchoring point, if you will, if you don't know what that reference point is, it's pretty hard to understand or decide, does this person's logic, does this person's description make a lot of sense? So I'm going to use this as the reference point. The column on the right on the far right in red, that's the July estimates from USDA. So they're forecasting both production as well as consumption. The column on the far right-hand side essentially are all forecasted numbers. We've got some survey-based information for plantings, for planted area. We're going to have some more survey-based information coming out shortly on yield and yield predictions. I'll talk about that in just a moment. But pretty much everything else in the column in red are basically mathematical forecasts based on what we see today, based on historical relationships in global markets. This is what USDA is projecting for bushels produced, bushels consumed. The column in the middle in blue is old crop numbers. So we're not quite to the end of the 2023-24 marketing year. So the marketing year starts on September 1. So in a little over about 3 weeks, we're going to be closing out this 2024 old crop season. We're going to focus only on the new crop numbers. So almost all of the numbers in the blue are very close to finalized numbers. We've been tracking these for now almost a year. Every month we get better updates, we get better estimates of what's happening, but very soon we're going to be closing out the books on last year's numbers and focusing primarily on new crop. And then the green on the far left-hand side is from 2 years ago. Those are all firm numbers. They're all locked-in numbers, but where you can use them as kind of, again, a reference point. So most of my conversation, most of my topic is going to be on the far right-hand side, which will be the red. One more comment now. On Monday, USDA is going to come out with their monthly update. So every month they update their forecasts. They're kind of constantly working on collecting additional data and information and trying to say, okay, given what we know today, what does that mean as we try and forecast forward? So let's dissect this into kind of some pieces or components. So on the very top, we have planted acreage and harvested acreage. The planted acreage, we had 2 surveys. There was one in March on what farmers were expecting to plant, what their intentions were. And we had a follow-up survey in June on what did you actually plant. And then from that, we look at what do we expect to see for harvested acreage. The reason I'm going through this is USDA changed their procedures just a little bit last year, and it may or may not have an impact this year. What they're going to do is in this August report, and so the August report's going to come out at Monday at 11 o'clock Central Time exact. USDA is going to update both their planted and harvested acreage, and primarily harvested acreage based on some of the early reporting we get from FSA, Farm Service Agency, as well as from RMA, Risk Management Agency. Now, it's really the FSA numbers that we're looking at because FSA, starting in August, starts to report prevent plant or destroyed acres. Now, RMA, the crop insurance guys, usually don't finalize their estimates and numbers until later on in the season. But the FSA people do start to, especially for prevented planting, start to report their numbers in August. So we may see some minor tweaks or adjustments. This was not a big PP year, because the prevent plant is not just a North Dakota problem. It can be a Minnesota, South Dakota, Northwest Iowa problem as well. So moving forward, that's one of the things. If we have a big PP year, don't be surprised to see some adjustments in this August report. But the real the real focus will be on yields, because August is the first time for corn and soybeans that USDA actually goes and surveys farmers and say, what do you expect your yields to be? So there's actually a survey-based estimates instead of using trend line. So in August, they survey farmers. They use satellite imagery, or what they call remote sensing, to try and make some early forecasts, some early refinements, if you will, to their forecasts on yield. So up until this point, we've been using trend line. So the trend line yield is basically historical yields. The red line that bounces around is our historical yields. And we're trying to look for what is that kind of long-term average. And we're adjusting that long-term average for technology, for better farming practices. So the little dot that you see on that line is the current trend line yield forecast from USDA. Notice it matches up with the blue line almost identically. So the issue now is, will USDA, given this new information, on what farmers are saying their yields will be, their best estimates. I know it's still early in the season, but we're starting to put some estimates together, as well as what we see in satellite imagery. And I'll show you some of the information that they're looking at in just a moment. So that will be one of the key things we're going to be looking for in Monday's report. So I don't expect to see any surprises, but as everybody knows, we get surprises periodically. So let's talk a little bit about crop condition and where we're at right now. Just wanted to remind everybody, this is the primary growing regions for soybeans from a geography standpoint. We're running from North Dakota all the way, kind of looping through, making a kind of a sideways swipe into Ohio. And then, of course, we have the Mississippi River Valley that goes down into Louisiana. The reason I'm bringing this up is one of the monitors or one of the measurements that the market uses, even though in my opinion, it's not a very accurate measure. It's in my estimation, looking at this drought monitor map is not a real good predictor of yield and yield probabilities, but it is something that the market pays attention to, that the somewhat uninitiated use to try and base some expectations or form some expectations about the future. And so we do have to look at it because this influences psychology. Now, if we look at the drought monitor map and we go back to this production zone, if you look at where we're at right now, there really doesn't seem to be any major problems in this core soybean producing region, with the exception of a pocket in eastern Ohio. But if you look at eastern Ohio, there isn't a lot of soybeans produced in eastern Ohio. And then down here in the Mississippi River Valley into Arkansas. And so there really isn't, into Mississippi. There really isn't a lot of major problems showing up. And that is also, being reflected in the weekly updates that we get from USDA on the crop progress report. So you probably heard on the radio talking about what percentage of the crop is in this good to excellent rating. Now that's a subjective rating. Okay, people drive around. It could be a county agent. It could be a county FSA person. They're driving around every week and they're looking at the crops and saying, how would you rate these crops in your county? It's a subjective rating. They do have some kind of descriptions of what would rate to be excellent versus what would rate to be good, however, or poor. However, it's a subjective rating. However, when you accumulate all of that, when you put all of those opinions together and look at an aggregate, they come up reasonably close. And right now, again, looking at this time last year, as of Monday's report, about 54% of the crop last year was rated good to excellent. This year, we got 68% of the soybean crop is rated good to excellent. So we've got a better year coming online. And I think that's, again, being reflected in the psychology of the marketplace. One of the other things that I just mentioned this from USDA's perspective, for quite a few years now, they have been collecting and analyzing satellite imagery, or what they call remote sensing, to try and look at, predicting or trying to come up with models to try and forecast or estimate what is the yield and yield potential going to be across the United States. And they're getting more accurate at that. They're getting better at that. So when they're updating the yield forecast now for this August report, they're going to blend the information they get from farmers with the information that they're seeing from the satellite imagery and saying, okay, let's put together some kind of aggregate or averaged, if you will, projection of yield. So this graphic, this is as of, the very end of, if you notice the dates, the very end of July up until August 4th. So it's basically an average over a week. What they're doing is they're looking at the NDVI, this vegetative health index, which is basically how reflective, how green is the crop. A really dark green is assumed to be a very good yield, or the crop is not under any stress, versus if you see some yellowing or some browning, the crop is under stress. Okay. Now, what they're doing and the reason I'm putting this up is it's not just the satellite imagery of what do we see. This is the deviation or the difference from normal. So is it above normal for this time of year, or is it below normal for this time of year? And notice the scaling on the far right-hand side. So most of the crop, and this goes from 2020, or excuse me, 2000, the year 2000 through last year. So we've got 23 years of data that they're using as the average. So what do we see today relative to that 23-year average? And if you notice, there's pockets in North Dakota where we're essentially above average. And I do think a lot of that has to do with some of the wheat crop, because it looks like we're going to have a pretty good wheat crop this year. But this would be not only wheat, but it'd be pasture lands. It's kind of all cropland area. Okay. My point in bringing this up is we really don't see any problems showing up. There is some in western South Dakota, eastern Wyoming. You get some darker, kind of darker browns in there, but there's really nothing out of the usual. So this would be ranked right now over the last 23 years as an average to slightly above average yield. So if we come back to our trend line, if we're saying, well, let's look at what is average, adjusted for better farming practices, we're going to have a pretty good year this year. The bottom line, nobody's really worried about yield and yield potential. And that is obviously having an impact on psychology in the marketplace, about forming people's expectations. Even if we did have some hot, dry weather coming up shortly, I'm not sure that would have the impact psychologically on the marketplace, simply because we've had such a really good growing season within the US, globally, that we have. So let's talk a little bit about the estimates. I'm going to focus specifically on the soybean columns on the far right-hand side. This is what the trade or analysts, professional analysts and traders are expecting to see. Okay, so let me explain this table. We got the corn side, you got the soybean side. I'm going to focus on the soybean side. So we're going to get updates on harvested acreage. Again, as I mentioned, we're going to get some new data from FSA primarily. We're going to update our forecasts, or USDA will update the forecast for yield based on this new survey data and satellite data. And from those two numbers, we're going to try and calculate or estimate what total production is. Okay, so the row on top in blue, highlighted in blue, is the average trade estimate. So there's about 25, 28 different analysts that are surveyed every month to say, what do you expect the USDA number to be? It's not their own numbers, not what do you as an analyst think. It's what do you think the USDA number will be? Okay, and so the blue, highlighted blue on top, is what the analysts are expecting. If you look towards the bottom, the highlighted black row is for the USDA numbers from last month. Okay, now we don't have the numbers, obviously, that have been reported yet. That'll come out on Monday at 11 o'clock. So the point is, what is the trade expecting to see? Yes, you were using now last month's numbers as that reference point. So we know that number, or do we think that number is going to go up or going to go down? So if you start comparing the blue line versus the blue row, versus the black row, we are expecting just on average, a slight decrease in harvested acreage. We're going to see a slight increase in yields, with then translating into a slight increase in total production. So nothing really dramatic, at least from an averaging standpoint. The other thing that I do, just as for me to try and kind of analyze and think about what might the market response be to these new numbers, I also look at the ranges. So notice that they have the highest trade estimate and the lowest trade estimate. That kind of gives us the boundaries. And at this time of year, we tend to see that range from the highest to the lowest being very, very wide, which means that there's a lot of kind of disagreement or a lot of differing views on what the yield and production potential really is. Now, when I go back and look at kind of what is the range, the highest versus lowest today versus what I've seen in the past, yeah, this is still a pretty wide range. There's still a lot of uncertainty. There's a lot of differing opinions, but that range is a little bit narrower than I have seen in the past. Typically, that range this time of year is much wider, just because we have this bigger uncertainty on what, in particular, what flowering is going to be for soybeans and then eventually pod set. So I wanted to give you some reference points. On average, we're not expecting to see any major shocks on Monday, but again, we don't know what the actual numbers are going to be, and there's a lot of disagreement on what could happen in that report. So I just want to, put a little bit of caution in there. Nobody really knows what's going to go on as we move forward. So let's look into the demand base now. So that's the supply side. And right now at this time of year, typically if the markets are going to move, we're going to have some kind of shock factor. It'll come from the weather and from some kind of uncertainty regarding production. And I know Mark is going to come on later on and talk about the weather and the weather outlook as we move into the rest of the season here. So hopefully he'll give us some better insights on what that will look like. The other side of it, and this is usually what I talk about most of the winter, is the demand side. So once we know how many bushels are there, now it's a matter of how quickly we're going to burn those up, how quickly we're going to consume those bushels. In soybeans, relatively straightforward and easy. We've got the blue line, which is crushing, and then you have the red line, which is exports. Now, the crush demand is relatively stable. Again, from week to week, month to month, year to year, we typically don't see big variations or a lot of unexpected shocks in crushing. We do see some surprises, obviously, in the export market. So when we look at the relative importance, crushing is critically important, but it tends to be relatively stable. Exports are obviously very important, but they're a lot more volatile. And so typically if we have some shock, some unexpected, something that everybody looks around and says, oh my gosh, what just happened? It usually comes on the export front. So I spend a lot of time talking about the export front, but I do want to acknowledge and recognize that the crushing demand is really, really important. And as we noted before we started the session here, we've got some additional crushing capacity coming online here in North Dakota, which is very, very exciting for the soybean industry. And again, I'll let Bill talk about his facilities and some of the things going on in the crush sector specifically. I get a lot of questions specifically for crush before I jump into the export side. So what's happening to the use of oil, soybean oil? We know that there's been expansion and growth in the biofuel sector. Renewable diesel is kind of this new buzzword that we're hearing a lot about. We've had biodiesel for a while. They're both really important within the fuel supply chain right now. The growth and expansion seems to be more on the renewable diesel side of the ledger, but biodiesel still has a lot of traction. So I just wanted to give some reference points. The blue line on top is the amount of soybean oil that goes into food and food products, which is blue. The red line is the amount of soybean oil going into biofuels. Notice the relatively rapid growth that we've seen since the mid or early 2010s. And a lot of that growth in biofuels has really been at the expense of exports. So we do have a few exports of soybean oil. They're relatively minor. But the other problem with this now, we're at a point where the biofuel sector can't necessarily steal what they need out of the export sector. So now the shoe is going to start to pinch, and we're starting to bind a little bit on, okay, is there going to be some competition for the supply chains, the amount of soybean oil going into the biofuel sector versus going into the food sector. One of the things I do want to comment on very quickly, because there's been some press on it, and I just want to make sure I clear the air. For biofuels, one of the other things that is going into specifically renewable diesel manufacturing has been used cooking oil, or what they call UCO, used cooking oil. The used cooking oil, from a carbon standpoint, has a very favorable carbon score because used cooking oil is literally classified as a waste product. So the assumption is, at least in the carbon math, the assumption is that cooking oil would go into some kind of disposal system, right? That it's going to leave the system. Well, if we can take this waste product and now turn it into a fuel supply or use it, and kind of recycle the carbon that's left in that's cooking oil, there's a plus, right? So from the carbon math, there's some real advantages to having used cooking oil versus virgin soybean oil, freshly crushed soybean oil. At least from a carbon math standpoint. From a processing standpoint, it's a little bit different. The point I'm trying to make is we in the United States have been importing a lot of used cooking oil, primarily from Asia, specifically from China. A lot of that cooking oil then has been pushing out some of the what we call virgin soybean oil, or the original soybean oil coming out of the processing plants, as a substitute, because it's kind of a lower cost substitute. It also has, again, as I mentioned, a higher carbon score. What's causing some problems now is that used cooking oil, there's some concerns that it's being spiked, that there's some palm oil that's being blended in with the used cooking oil, that the numbers for the availability of used cooking oil versus our imports of used cooking oil aren't quite adding up. And so there is some federal investigations going on right now. There's a an announcement on Reuters this morning that was talking about that I think it's the Department of Energy is doing some investigation into the used cooking oil supply chain and exactly what's happening there. And there's been some proposals put forward to restrict or limit the amount of used cooking oil coming into the United States from a regulatory standpoint, in particular that goes into this biofuel sector. So that is something we're going to be watching pretty closely. It has more of a direct impact on the soybean oil futures. So I'm going to be very, very specific here. This is a big deal for the soybean oil complex, the vegetable oil complex, which does translate then or ripple back into soybeans, whole soybeans, but it's not a direct effect. So there's kind of a shock absorber thing going on there within the soybean complex. When we look at meal, again, the question is, well, with this expansion of crushing capacity, we're after the oil for this, especially renewable fuel sector. What happens to the extra meal? Obviously, we've seen a slight increase. The blue line on top is the amount of soybean meal going into domestic consumption, primarily into livestock feed. We've seen an increase in that, but it's been a slow grind upward. A lot of people are looking to the export market as the alternative for trying to move the extra soybean meal that will be generated. There are some challenges with that, but in my opinion, my assessment, long term, not necessarily short term over the next couple of months, but longer term, in my view, there is a very strong demand base, in particular out of South Asia, not necessarily North Asia like a Japan or a Korea or China, but mainly out of South Asia for some additional U.S. Soy meal exports. It's a matter of pricing and trying to get the logistical system to be able to work. So it's a supply chain. I think there's some kinks in the supply chain that we're going to have to work out because some of those countries don't have the ability to receive and handle big shipments like a Panamax full of soybean meal. They're looking at smaller volumes, especially to start with. Okay, so let's move into the export sector. This is the tail end of last, kind of the old crop marketing year. I will make some comments about new crop marketing year. One of the challenges coming into this year is we have some pretty good carryover stocks from last year in the soybean market coming into this year. Okay, coming into the new crop marketing year. So we have a lot of beans from last year that we're carrying forward. And the reason we have a larger supply of old crop is because our exports have been relatively weak. When you look at it as a whole, when you look aggregate at all exports. What I've done here is tried to break this down into exports by country. I do want to explain this table just very, very quickly and very briefly, just to give you an idea of what's going on. So if we look at this, the four columns on the left-hand side, those four columns reflect the annual export sales by country. So these are final official numbers of beans that have left the United States and ended up in one of these countries, okay? So you can see China hit even during the trade war. So 2019-20 is kind of the tail end of the trade war years, the trade war that we had with China. And we can see even during that time period, China was still our number one customer, right? And we did see a recovery or pretty quick rebound in 2020 and 21. That was really that phase one trade agreement. When we look at what's going on today, so these two columns on the far right-hand side, this first column labeled 22-23, that is total sales commitments. So those are like contracts for the delivery of soybeans in this marketing year. Okay, so the column here in the annual total is the official number at the end of the year. This is contracts that have been sold, but some of them may not have been delivered yet, okay? Or there may have been some sales that have occurred that haven't been delivered, okay? So when we compare the sales for this time last year versus this time this year, so this is sales through the most recent report last Thursday. I wasn't able to update the numbers this morning just because it comes out at 7:30, and I just didn't have time to be able to get all of that compiled and compared. The point is, our export sales into China are off pretty significantly. Okay, we've seen kind of some trend lines, some bouncing around here, but this 23-24 export season for the United States was not a very great export season directly into China. primarily because not only the harvest in Brazil this last year, but also 2 years ago, they had very, very large soybean productions. The Brazilians had a lot of carryover stocks. They were being very aggressive in trying to get their soybeans priced and pushed into the global market. Obviously, the Chinese are very smart buyers. They came in and tried to purchase and buy up as much of those soybeans as possible. When we look at number two customer is Mexico. Again, relatively, that we see some bouncing around in their historical export sales to Mexico. Obviously, a big drop from the number one buyer to the number two buyer. But Mexico has been, kind of that steady customer. Their purchases so far this year are very comparable to what we saw this time last year. The reason that there's a difference in this year-to-date, this number in this column for 2022 versus the final number last year is that some of these export sales that were on the books for delivery during the marketing year essentially got rolled forward into the next marketing year. So it's not that they were necessarily canceled. The orders weren't canceled. It was just the timing of delivery was shifted. And so it got rolled into the numbers for the 2023 marketing year instead of the 2022 marketing year. And then we get into some of the other countries like Japan, Germany, Indonesia, Spain, Netherlands, etc. Let me make a really quick comment about how are we doing so far for this export season, for new crop, because obviously new crop you can buy today for new crop delivery. When we look at the numbers today relative to where they were last year for new crop, we don't have a column for that yet. The Mexican purchases have been pretty good. So Mexico for 2024 production has come in and booked some purchases. Okay. But the Chinese have not. We've had some recent sales over the last couple of weeks that have kind of caught the eye of the marketplace. That China's finally shifting back into the U.S. supply chain. They're going to be buying some from the United States. But when you look at the numbers they have booked so far this year versus kind of what we've seen historically, they're a bit behind the pace. They're a little slow in coming back to the United States for their new crop purchases. And I do think that will pick up simply because some of the old crop out of Brazil is starting to slow. But Mexico pretty much right on pace, if not ahead a little bit from last year's sales. One of the things I also want to point out is we do have some very seasonal export bookings. So when we look at the numbers, this is kind of the starting in the marketing year. So far, we're coming in with the numbers for 2024, very similar to what we saw kind of last year, the last couple of years. But you notice this big seasonal pattern for export sales. Now, export sales and shipments are a little bit different, but they tend to follow pretty closely together. So we see what they call the gut months, which is the big heavy shipping season of October, November, December. We see this big seasonal pattern. If you look at the red line, that's where we are today. So the red line is old crop. The new crop isn't on this graphic yet, but it will come in about that 500 million metric ton. So the point is, we're pretty much at the end of this season. We're seeing a slight uptick towards the end of the season, but I really don't see a surge of export sales and deliveries coming up for old crop. We're going to have to really focus on the new crop sales. So how are we competitive in the global markets to try and kind of close this thing out? So when we look, and again, I want to put some perspective, some history behind here so you can set some expectations going into this harvest season. What do we expect to see? What should you kind of be listening for changes in pricing and pricing systems? So the blue line represents soybean exports out of Brazil. And again, the dotted line is the current USDA forecast for 12 months. That'd be for the marketing year. Okay, so that would be export sales out of Brazil. The green line is export sales out of the United States. So last year was not a great shipping year for us, sales and shipping year. We are expecting to see a slight increase. At least that's the current expectation. That's the current forecast. Notice for whole soybeans, we tend to have two big sellers, which is Brazil and the United States. Argentina and Paraguay do sell some whole soybeans. Most of the soybeans in Argentina are processed first. So they're selling soybean oil and soybean meal, not necessarily whole soy. Okay, so they can sell whole soybeans, but because of their taxing system, there's some advantages for them to crush it first and then to be able to sell the oil and meal. Okay. And then we have the red line, which is the imports from China that China have from the global market. So this is all imports of China, not necessarily how much comes from the US versus comes from Brazil, but when we think about all imports from by the Chinese. So looking at the global trade in whole soy, this gets pretty simple. You got one big buyer, which is China, and you've got two big sellers, which are the United States and Brazil. And one of the things I just wanted to point out is I'm looking forward in time and trying to set some expectations, saying, what do we need to do to be able to push this 2024 crop through the system? How do we chew up those bushels that we're going to be coming off and combined here in a few weeks? We're looking at, again, crushing demand and export demand. Now, for a long time, we've been relying on this nice, steady, long growth in the growth rate of soybean imports by China. And if you notice, it's starting to it's still growing, right? It's still expanding, but the rate of growth is starting to slow. And I'm getting a little concerned about that. There's a couple of reasons for it. Part of it is their economy is not growing as quickly. And part of it is that they're being more selective in how they're buying. And the question, I guess, the unanswered question in the marketplace right now is, are they starting to change the way they're managing their inventories? Because the Chinese government is responsible for managing their kind of inventories and reserves or their stocks. And there's some questions starting to flow around. Have they started to shift their strategies in their domestic storage and production systems? Most of this, in my estimation, my assessment, my personal view, is a lot of that is just simply because their population growth rate is starting to slow and their economic growth rate is starting to slow. So they're still expanding, they're still growing, but not as quickly. But on the flip side, we're seeing continued expansion and growth in the Brazilian market, the Brazilian production market. So the Brazilians are supplying more. The Chinese demand is starting to slow a little bit. It's still growing, but at a slower rate. You know, what does that do for the United States and our ability to be able to compete? And again, these are longer term questions that we're going to have to be following as we move forward. So what does all this mean for pricing? Finally getting to, you know, some of the key things that we're going to be talking about and putting some strategy together as we move into the harvest season. Okay, the green line on top is total soybean production out of the United States. The red line is total consumption, which includes both domestic use as well as exports. I want to focus on the blue bars on the bottom. Anybody that's heard me talk over the last several years, I like to focus on those blue bars, which is the stocks to use ratio. So how much grain are we going to have left in the bin? How much reserve do we have? How much kind of cushion or buffer do we have? Ending stocks divided by total consumption. So if we do have a problem, if there's kind of a shock absorber effect that needs to be happening, it's typically in the United States comes from our ending stocks. So if that ending stocks is relatively large, we've got a lot of room to be able to absorb some shocks into the system. We tend to see two things happening. We tend to see lower prices in aggregate or in general, but we also tend to see less price volatility. So if we have big inventories, on average, we have lower prices with less volatility. If we have very tight supplies, if our ending stocks, if we're coming in on fumes, we tend to have higher prices because we're trying to ration consumption, but we also tend to have a lot more price volatility. The prices really start to swing wildly because any new piece of news or any change in our expectations suddenly has this big shock value. So what I like to show is these blue bars and the height of those blue bars relative to our long-term prices. And now this chart is a chart of long-term prices for soybeans. This is futures prices. They have not been adjusted for inflation, so I just want to caution you on that. So the prices here back in 1990 are $1990, so we'd have to make some adjustments. But this is a graphic that I can pull very quickly. So as of last night, and I pulled this chart last night, this is September futures at 1023. So that would be September, not November. September futures at 1023. So that's where we're at right now. So let me go back one. If we look at this time period when we tend to have, and again, this is our trade war year. So recognizing this 2018-19 was the peak of the trade war. We started building, we came off of some very low inventories. We built inventories very quickly because we couldn't export anything. We're able to take those inventories back down again, but now we're seeing a resurgence or rebuilding of those inventories. And if we start looking at that correlation, the relationship between very high inventories with lower average prices and less volatility versus very tight supplies when we have a lot of higher prices with a lot of variability, we're still in this transition, right? So my point, the reason I'm bringing this up is if USDA forecasts are correct, and right now I have nothing on my radar that would say that they're dramatically or drastically wrong. Okay. We are looking at lower prices. We're coming into a season. I think everybody's starting to realize that now. We're coming into these lower pricing, patterns with more stability, which makes it a bit more challenging from a marketing standpoint to say, when do you pull the trigger and when do you make some sales? Everybody would love to have, these 2020 and 21 pricing and 22 pricing back again. It's not going to happen this year, guys. I'm sorry. I got to tell it to you with the bark on. Okay. We are looking at some lower prices. We're looking at lower price volatility, which means you will get some price responses. There will be some pricing opportunities, but it's not going to be a great big long run unless something very dramatic happens, something very, very unusual. Okay, so I'm going to go back to this red bar right here. This is the USDA number we got out of July, the July estimate. We're going to get some new numbers on Monday. The question is, what are those new numbers going to look like? Blue line on top, that's the current estimates from the trade. So this is the average trade guess. So let's look at soybeans. Last month, we had 435 million bushels. 465 is the current guess. So we are expecting, given a slight increase in expected yield, I don't think the trade nor USDA will see any major adjustments in the consumption side. So if we have slightly higher yields, most of that will translate into bottom line. And I think this again was setting the next expectations. So that red bar that I showed might tick up just a little bit. We'll have to wait to see. So this is my last graphic for this session, and I know I'm getting very close to my time, and I do want to leave a little bit of time for some Q&A before I transition into the kind of the charting and the technical analysis. But I wanted to show this graphic as kind of that transition from looking at supply-demand conditions into some of the discussions on the charting techniques. So this is for November soybeans. So again, if you're looking at harvest delivery or beyond, November beans will be the futures market contract that the elevator and the processors are going to use for pricing. You notice that we've seen this downward trend in prices ever since this March, April, May. We were kind of in a trading zone, a trading range up here, coming off of last year's. This will be November of 24, priced in November of 23. So this time last year, we're looking at much higher prices for 2024, simply because we didn't know what all of the details of the 2023 marketing year. We had some, I guess, a little bit of a surprise in the soybean market. We didn't plant as many acres, but you can see as we moved through the summer months, as the weather cooperated with us and we started building some higher and higher yield expectations, some of that started dropping off. And so as we get into this arena right now, we are still looking at, my opinion, at a trading range. The question everybody's asking me is this, kind of this 10-10 on the futures, is that going to be our low? Have we seen the low point in pre-harvest pricing? And I'll be very blunt, I don't know that we have. We may have some more downward pressure as we get into the harvest months. And it will all depend upon what kind of that yield forecast. As we get into September, USDA will update their September estimates. They're going to add another system for their forecasting for yields. They're going to add actual field observations. So they're going to resurvey farmers. They're going to update their models based on satellite imagery. And they're going to add another data point, basically another estimate for actual field observations. And so as we move forward now, the question everybody's asking is, if we start to see that average yield start ticking upwards, we will likely see a corresponding drop in prices. So when it comes to marketing strategies, when it comes to looking forward, right now there just isn't a lot of things either on the weather side nor on the political side that have, in my opinion, a lot of shock value that's going to put a big lift into the marketplace. Okay. Now I will get into a little bit more of this discussion and kind of the mentality and psychology of the marketplace in just a few moments when we get into the technical analysis, but I want to take a short break here. So I'm going to stop sharing for just a second. And I want to see if there are any questions that have come into the chat that I can try and answer before we transition from the supply and demand into kind of this technical analysis piece.
I don't see any, Frayne. But if anyone would like to put one into the chat quick, excuse me, I'll keep an eye on that for a couple minutes while Frayne pulls up his next.
Okay,
slide.
there is one more slide I wanted to show. I forgot to do this. So let me I have to get back to my share screen thing here. So this was my last slide. There was one more I added to the deck kind of last minute. So just to say, I just wanted to, again, from a reference point for exports and kind of how competitive are U.S. soybeans in the global market. So the purple line is basically that's the asking price, or that's the price offered for sale into the global market. So this is from Thomson Reuters. The purple line is out of the U.S. Gulf. So this would be kind of current sales based on a U.S. Gulf price into the global market. And this is in U.S. dollars per metric ton. Okay, now the green line is Brazilian soybeans coming out of Paraná. And then the kind of that goldish or yellow, kind of goldish line is the Argentine, what they call upriver. So a lot of the vessels in Argentina can go up up their Paraná River for quite a ways to be able to be loaded. It's kind of like the U.S. when ocean vessels can go up the Mississippi River a ways to be able to load from a port. So we're looking at Argentine prices in gold. This is for whole soy. The purple would be the U.S. Gulf, and then the green would be coming out of Brazil. Now, notice again when we're looking at in that period of that Jan, March, April, Jan, February, March, excuse me, time frame back in this time horizon as Brazil started harvesting and exporting all of their soybeans, the U.S. was essentially priced out of the marketplace. I mean, we did not have a competitive advantage in the global market based on relative prices. Now, notice what's happening as we start coming into our harvest season as the Brazilians start to kind of slow up their export pace. A lot of their old crop has already hit the marketplace. We're now at a point where the U.S. Gulf is competitive. So U.S. prices for soybeans are becoming more competitive. We have this expectation for a larger soybean crop coming into the harvest season now. And so the world, not just China, but the world will start shifting their interest and some of their buying habits away from the Brazilians and into the U.S. system. And I know Bill Wilson will be talking about some of that when we talk about basis patterns and kind of basis flows. So I just wanted to update. That's kind of my last slide to make sure that, yes, I know prices are low, but we are competitive now in the global markets, and we are going head to head with the Brazilians.
Frayne, I have a question.
Certainly.
As
I'll
you
stop
are,
sharing for a second.
no problem. If you want to pull up your next slides, you can too.
Okay.
So as you're looking at these whole soybean export numbers, soybean use numbers, at what point do we see a shift in those whole soybean numbers because we're starting to see the soybean crush kind of glut hit the market? I know that some of the soybean plants are built, some are not, some are online, some are not, especially in North Dakota. So when do we start to see and expect a change in the whole soybean numbers because they're being processed in country?
Okay, so I'm going to go back to a slide, just a second here. So you can see my slide deck, correct? Yep. Okay, cool. I'm going to go back to a slide back here. I just want to try and answer your question directly, because this is a really good question, something that I get on a regular basis. So we need to separate a little bit about what's happening locally within North Dakota, within this region, because obviously we have a couple plants here. We've got some additional construction going on in South Dakota, which will draw some of those kind of southern North Dakota soybeans as well. But let's look at this blue line, right? The blue line is again, the forecast or the estimate for amount of whole soybeans going into the U.S. crushing sector. Now, these are numbers that USDA put together. There's also what's called NOPA. It's the National Oilseed Processors Association. So they currently, now the Casselton plant, North Dakota Soybean Processors, when I put this together, was not listed as operational yet. Okay. But as of, a few months ago, NOPA listed 63 processing plants across the United States. NOPA and their membership accounts for about 94% of the U.S. crush capacity. So the Spiritwood plant, the ADM in Spiritwood, that plant was listed as one of these 63. So when we look at it from a larger market segment, when North Dakota Soybean Processors comes online now, as they start receiving beans and cranking up and getting meal and oil crushed, they're going to go from 63 plants to 64 plants. So in a big global sense, that's a pretty small percentage increase. For our region, it makes a really big difference. Okay, so when we think about the supply chain and the amount of soybeans that we're pushing into the market in PNW, the amount of soybeans that we're pushing into the Gulf of Mexico, in a big picture sense, the addition of the capacity up here is not going to have a huge impact on these big aggregate numbers that I've been talking about. They will have an impact on our flow of grain locally, without a doubt, without question. They have to change. Historically, we have been very, very PNW dominated. We have been with not only our basis levels, but with our flow of grain. When we think about when is soybeans delivered, when are they shipped out, where do they ship to? One of the changes now in our local supply chains, this is more of a local issue, is that we have to now incentivize farmers or elevators or both to be able to store those soybeans longer, to be able to fulfill those processing needs for these plants throughout the rest of the year. So what it's really going to do from a pricing standpoint and from a flow of grain standpoint, we're still going to have those seasonal patterns, right? We're still going to have to take a bunch of our soybeans and put them on a train and push them out to the PNW because the international market's going to need those beans. But they're going to have to compete a little harder to pull those beans away from storage and from the domestic crush or from the crush capacity that we have locally. Does that make sense?
Yes, so you're saying in terms of these USDA national numbers, we're not going to see a huge shift in like where did 30% of our whole beans go? Question.
Correct.
Got
So you're asking the right question. It's just it's a localized issue.
Sure.
It's going to be something that impacts that. We're going to feel it. We're going to notice the difference. But from a national standpoint, we're really not. It's just going to be another step in this progression of expansion of crush capacity that we've seen over the last several years. So notice that this blue line has slowly been chugging upwards for about 10 years.
Yeah.
And it looks like now it's growing a little faster than it has in the past, but it's still kind of on this nice steady chug.
Mm-hmm.
So we right. And so what I'm getting at, and I think Bill can elaborate on this a little bit more and during his talk, but what we're seeing is most of these local shifts are going to be reflected in the basis levels.
Okay.
They're not necessarily going to be reflected in the futures market levels.
Okay.
Because the futures market is really concerned about those bigger picture issues, about what's happening around the whole US, what's happening globally, to try and help regulate the flow of grain over time globally. And the basis levels is your local market talking to you and saying, what do we need to do here in North Dakota
Mhm.
that might be similar or different from what's happening at a national or global stage.
Sure, that makes sense. So we've seen this crush expansion come on pretty steadily, not all at one time.
Correct. Yep. From a national perspective, we've seen this growth occurring over the last several years. The rate of growth is starting to increase. We're growing a little faster than we used to.
Mhm.
We're adding more plants than we normally have, or more capacity. And again, a lot of the capacity, I want to be very careful how I phrase this, because a lot of these are, this 63, those are crushing plants. Some of those plants have been expanding. Okay, so there are existing facilities that have added additional crush capacity. And so some of the growth you're seeing is not necessarily new, what they call greenfields plants, like the North Dakota soybean processes, where it used to be a green field and now we have a plant. Okay. A lot of these were existing plants that have expanded and grown and grown their capacity internally. They're not necessarily building new facilities. So we're seeing a combination of both right now.
Sure.
Okay.
Okay,
Good question.
you were on time and I made you off time.
No, that's okay. That's okay because I know that the technical analysis part I can kind of expand or compress that. So I want to make sure that we stay on time, and that we have enough time for Q&A later. So be thinking your questions, guys. Be thinking of questions as we move forward. Okay, so a couple things now that I want to just point out before this is I'm using DTN ProfitX as our basis, as our kind of the baseline. The reason I use this is very flexible. I can manipulate the graphics very quickly and easily. So I thought I would try and do this rather than going through a PowerPoint presentation. Just try and do it at real time. We'll see how this goes. I've done it before. It seemed to work pretty well. So here is the soybean complex right here. We've got corn off to the left, so kind of middle center of your screen. Are the prices. Every time you see one of those blue things flashing back and forth, that would be a trade. So we're getting this as live update. There's no time delay. I'm going to click on the November soybean. So really, I'm just going to focus on the November contract as kind of that kind of main one that we're looking at. That's got the highest trading volume. It's the one that we're going to be focusing on the most. So before I dive into kind of the pricing patterns and pricing movements and rate of change and some of the analysis things, I do want to talk and comment a little bit about, as I mentioned earlier, the carry in the market. So the carry in the market is these price differentials when you look at, for example, the November price at 10.17 versus the January price at 10.33 versus the March price at 10.48. So the carry in the market refers to that increase in prices as we move forward in time. Okay. And that's really what the big global market, that let's talk about the US market as aggregate, is saying about the incentives to store. So typically what happens, not always, but typically what happens when we have a really big crop, when we have a lot of supply, we've got a lot of inventory hitting the marketplace, the futures market provides an additional carry. So those step ups in futures prices is trying to incentivize storage, saying, okay, look, we can only handle so much grain so fast. So we're going to provide both farmers and elevators and processors an incentive to store and deal with it later. Okay. Now, when we have a very small crop, when the supply chain is really tight, we don't have a lot of inventories, we tend to see either very little carry or actually an inverse, which means that there's no incentive to store. So in that case, the prices as we move into the future are actually lower than the prices we see today. So this is just basically, from my standpoint, confirmation that from a really big picture, high level sense, there's a lot of people that are looking at this and believing that we're going to have a really large crop because we're seeing this carry being bid into the marketplace. And when you look at the rate of carry, the amount of money that the futures market is providing, this is pretty substantial. So we're getting not totally to what they call full carry. There's not enough of incentive in the futures market to pay all of your storage costs, but the futures market is paying a large portion of those costs of storage. So again, in my mind, in my assessment, when I look historically, This is another signal that the marketplace, the mentality of the marketplace right now is we're going to have a big crop. We're going to have lots of supplies. We're going to need to try and spread this consumption out. We're going to have to try and take this really big crop and spread it over a longer period of time, which means now that we're going to have to worry about storage. We're going to have to worry about managing the flow of grain into the future. So what I usually figure, if you do the math right now, if you look at today's prices, cash prices at the farm gate for North Dakota farmers, you put an opportunity cost on interest, you're looking at 6 to 7 cents a bushel a month just for interest costs. So just the cost for you as a farmer to put it in a bin and store it and deliver sometime into the future, it's going to cost you between 6 and 7 cents a month just in interest. So you add on, other expenses for storing grain and the risk that the grain might go out of condition, and all of a sudden you can get to, 8, 9 cents per bushel per month really quickly. But if you look at the numbers here, the futures months, 10.15 to 10.32, that granted, that's a 2-month period, but the futures market is paying for almost all of the interest costs for carry. And to me, that's kind of an important signal. It's an important thing to keep kind of in the back of your mind that right now, today, and again, those changes in expectation can happen tomorrow or a week from now, and all these relationships can adjust. So that's the beauty and the beast of the futures market is they change very, very rapidly. All right, so let's dive in and look specifically at the November soybeans. I'm just going to give you a couple things from a technical analysis standpoint to give you some pause and some food for thought. Now, my caution is before I go into this, the techniques and kind of the systems that I'm going to be talking about, I only have time for a few of them. There's a lot of different analysis. There's a lot of different ways to think about this. I've only picked a handful of kind of techniques that are commonly used within agriculture. These are ones, analysis techniques that I often see other analysts and traders talking about. So I want to give you some reference points, kind of show you how to use some of these techniques if you're interested. But the one caution I'll have is most of these techniques are kind of relatively short-term focused. So as a farm manager, especially for storage, one of the things you're thinking several months into the future. If I put grain in the bin here at harvest, do I deliver in a December time frame, a January, February delivery time frame? You're looking, several months into the futures, or into the future, into the timeline. But a lot of the futures market traders are very, very short-term focused, okay? So when we look at these analysis techniques, when we look at some of the systems that have been put in place to say, well, let's look at trends, let's look at pricing momentum, this is much more short-term focused. So the things I'm going to show you will probably work pretty well over the next several weeks, maybe up to a month. So from a planning horizon standpoint, we're looking at like 1 to 2 weeks. This will be, I think, relatively accurate, maybe up to a month. But beyond that, some of these techniques start to break down. So for long-term forecasting, that gets to be, when we're looking at like multiple months, it gets to be much more challenging. Okay, so recognizing that we're looking at kind of a short-term focus, we're looking at the next couple of weeks and price movements over the next couple of weeks. So the black bars, the black lines are bouncing up and down. Those are the futures market prices for each of the days. So each one of those represents one day. I've drawn in those blue lines. So one of the basic kind of most common techniques, most fundamental techniques, if you will, that are used is called support and resistance lines. What we're really looking for is where prices have fallen to a point and then they've kind of reversed direction. So we're looking for price drops like that or price spikes like that. And so these lines then become kind of these psychological or mental barriers. So if we start to see prices falling, at what point will people say, well, I think prices have fallen enough. We're looking at kind of a support level. Prices may not fall below that given the information we have today. And at what point will they start to rebuild? Well, if we start to see some rallies going on, how high will prices get before they start changing or flipping again? At what point do we see these price movements or these price trends start to shift? And so these blue lines are kind of common techniques that are used. They're a little bit subjective in which points do you use. These are the points that I have been using. I just want to go through some of these and just show what's going on. So this black box on the far right-hand side is where we are in the futures right now. Those are the exact trades. If we look at this blue line underneath it, it looks as though we have put in a floor, that there's some support starting to build. So since the end of July, these first few days into August, yes, we've seen these downward prices, but I think the market now is kind of in a pretty tight trading range from about this 10.15 to about this 10.40 mark. We're kind of in that pricing range. So the question I always ask farmers is, well, if that's kind of the current zone that we're in, what would change? What would change in the future to possibly say, well, that's too high. We're going to have more supplies than we expected, and where we need to push prices lower or prices below about that 10-15 mark. Or on the flip side, if there's something price positive coming into the marketplace, at what would cause that mentality or that shift to cause prices to go higher, where a buyer would say, I'm a little bit worried, I'm a little bit concerned, I'm going to buy some more soybeans today and take some additional coverage. Okay, so I do think, based on this very simple technique of support and resistance levels, it does look, this 10-15 looks like kind of a support level. Given the information we have today, that looks like we're kind of in this low end trading range. Now, let me just adjust this really quickly. I put this 10.97 as one of those kind of key price levels. And realistically, you could probably move that down a little bit and say, well, if we were to get a rally, okay, if we were to get a rally, the first kind of test of this rally, is there enough worry in the market? Is there enough buying support to push us, to pull us essentially through this 10.42 mark? Let's call it 10.40 for easy figuring. And that, I think, could be relatively simple, relatively easy, depending upon what happens in the marketplace. The next big question is, is there enough momentum? Is there enough support in the marketplace? Is this a big enough issue to be able to pull prices and raise them through about this 10.85 or 10.90 number? So this will be the next kind of big test to say, well, if we do get a rally going, is there enough momentum behind this to pull prices higher and push us into a higher market level? And right now, to be very blunt, when we look at supply-demand conditions, when I look at the fundamentals, I really don't see anything over the next couple of weeks that would do that, unless we get, again, either some kind of unexpected change or shock into the USDA numbers, which I'm really not anticipating, or we get some weather issues starting to develop, which Mark Ewens is going to talk about, or we talk about some unexpected political change. And again, when it comes to the turbulent, political environment we're in right now globally, and I'm thinking about geopolitics now, in particular, some of the issues going on in the Middle East and some of the issues continued to go on in Russia and Ukraine. Some of those things can explode relatively fast, and we just don't see them coming. Okay, so let me add another, given the time, let me add one more study here. I'm going to use excuse me, I'm going to do the Bollinger Bands. So we're going to add the Bollinger Bands. One of the reasons I like to use Bollinger Bands, and again, I'm looking at the red line, it gives us an idea of a moving average. So this is kind of a reflection, or we're looking backward saying, where are the trends? Has the trend line, the price trends, have they started to flatten out or not? And also then we're looking at this price volatility issue. So the shaded area is kind of an estimate of price volatility. So if prices are really volatile, we tend to see that shaded area get wider. But I'm really focused on this red line kind of towards the middle, saying, well, that's a 20-day moving average. So about a 1 month moving average. How do we see today's prices relative to this longer term moving average? Now, the moving average, it looks like it's still going downwards. We'll need a few more days, I think, within this trading zone for that red line to start to curve and flatten out. So right now, as an indicator, it still looks like we're in this downward bias in the marketplace based on this indicator. We still have some price volatility in the marketplace, but not like what we've seen in the past. if we were to go back here in the time frame into kind of last January, we had a lot bigger volatility. So that shaded area was much, much bigger than what we're seeing today. So I guess I would look at it and argue that we're in kind of normal price volatility for the last, last month or so. Our averages are still kind of pulling down. Okay, let me add one more. Add study. This is also one that I talk about as relative strength index. It's an indicator of kind of price momentum and where we are. Are we in kind of a downward or negative movement, or are we in more of a positive movement? So this is a ratio of the number of down days relative to the number of up days. Okay, so our prices moving lower more than they have been moving higher, or prices moving higher more than we've been moving lower. So a ratio of 50 means that the days of up prices movements and the days of down price movements have been equal. So again, what we're looking at is not only the level, we're seeing a 37, which means that we've been having more down days than up days. But we're also looking at what is the change. Is this moving upward closer to a 50, meaning that we're kind of restabilizing, we're going back to more of a neutral instead of a downward bias, we're moving back to a neutral bias? Or are we looking at, for example, back here, well, we have been in a downward movement and it looks like that downward movement is gaining momentum. So based on this indicator, we're still in kind of this downward, we're in the bottom half. We have this downward bias. We've had more down days than up days, which again is obvious. The question is then, what is the direction for this red line? And it looks like, again, in my opinion, looks like it's relatively flat. I don't know that we're still kind of having this downward momentum, but we're stabilizing. It's not that we're moving back to a neutral position. So I'm going to take this one off because otherwise it's going to get really crowded and clustered here. I'm going to add one more that I do want to spend some more time talking about. I got to add a study here. We're going to go to the MACD. So this is kind of my last kind of indicator. The last one that I really want to spend some time talking about. And it's the MACD, or moving average convergence divergence. So what we're really looking at in this one, and let me make sure that I get this spread out a little bit more so we can see better. That's too much. Sorry about that. Let me move this up. Come on. There we go. Let me move that up a little bit so we can see it a little bigger. So again, what we're doing is we're using the information in the black lines, the historical, and we're looking backwards, and we're trying to say, what can we see in the information looking backwards that might give us an indication of what's moving forwards? So for those of you that have gone through some of our training programs in the past, I've talked about this. When Bill Wilson and some of his graduate students do an analysis of how accurate are these predictors, this MACD is one that usually comes in as being pretty a reliable indicator. Nothing's perfect, but it's got a pretty decent track record. Okay, so how do you read this graphic? What is this telling you? So the red bars represent kind of momentum in the marketplace. Okay, so what we're really doing is measuring the distance between the green line and the blue line. They're just moving averages. So let's not worry about that. Let's just talk about what is this telling us. So if these bars are below zero, it means that prices have been moving lower. And basically the height, or the size of that red bar indicates how quickly the market is moving. Okay, so what this is showing on a downward trend is that, yes, prices have started moving downward, but that rate of change is going faster. So we're moving downwards, but we're moving down very rapidly. And then as these red bars on the bottom saying, yes, we're continuing this downward movement, but what about the rate of change? So as these red bars get smaller, it's saying, well, we're still moving down, but it looks as though that downward movement is slowing. We had a little bit of an uptick. Again, that reflects that mirrors what happens here. We're seeing some more downward moment, not only downward movement, but that momentum is gaining momentum. We see a little bit of an uptick where prices were moving up, and they were moving up at a little higher rate. And then all of a sudden now we've been in over the last several days in kind of this sideways pattern. So what this is showing me, what this is telling me is that, yes, for the last about week or two, we've been in this sideways pattern. We really don't see a strong momentum upwards. We don't see a strong momentum downwards. We just get additional confirmation that we're kind of in this sideways trading pattern, that there isn't a lot of new news. There isn't a lot of new things happening, that we've developed this pricing range where everybody seems to be comfortable. Okay. So Jenna, I just want to take a pause to see if there's any questions. Because I have one or two more comments to make, and then my session will be done, and we can take a short break, and everybody can fill up their coffee pots and
Yeah.
and get ready for the next session.
I don't see any questions in the chat at this point. So if anyone is forming a question, now is the time.
Yep. Okay. So as long as there's nothing that showed up, I'll kind of continue to. I've got a couple more things to talk about. Then I'll be finished. Okay.
Okay, sounds good.
All right. So summarizing very quickly, we've got several indicators, both the very basic, support and resistance levels, as well as moving averages, as well as these MACD indicators are saying, well, it looks like we're in kind of a sideways pattern here. So as you know, we've been kind of quiet, right? Both the corn and the soybean market have been relatively quiet for a while. We're not getting any big weather concerns. We're not getting any big weather shocks. We haven't seen any major disruptions yet in the international markets. Some of our traditional seasonal patterns for international buying are starting to come back. They're a little bit slower this year than we would normally see. But we're just in this comfort zone. Like I said earlier, if I'm a buyer of soybeans right now, especially in the international market, I'm not terribly concerned. There isn't a lot of things that's keeping me awake at nights. So I want to show one more thing, and this is also one of the reasons that I wanted to use this particular software package. I do want to talk a little bit about the investment community and the managed funds, that this outside investment community that's now coming to agriculture, and they're starting to buy and sell and trade futures markets. So I do want to, because this is something that farmers have questions about. They're trying to put their mind around, what does this mean? What is it? What are the implications? So this is, as you notice, let's look at the timing. This is from a pretty long time frame, from 24 all the way back to 2018. So these black bars, those represent what's called the net position for these managed funds. So this would be the outside investment community that are buying and selling. This would be for soybeans. And so we always have buyers and sellers. In the futures market, for every buyer, there has to be a seller. Same thing in the cash market, right? But when you buy or sell a position, you can hold that position. So it's a contract for future execution. So we're looking forward in time, right? So if you're a speculator and you think prices are going to fall, what you do is you sell a futures contract, wait for the prices to fall, and you buy it back later, and then you lock in your profits. Just like buy low, sell high, you can sell high, buy low. So we have speculators in the marketplace, these managed, these hedge funds, right? These managed money positions. Some of them are buying, expecting prices to go up, and some of them are selling, expecting prices to go down. Again, so if you sell today, you wait for prices to fall lower, then you buy it back later. And so what this graphic shows is the net position. So you take all of the people that have been buying and waiting for prices to go up relative to the number of people that are selling and thinking prices are going down. And the reason we focus in on these is this kind of net position is because when those investors start changing their attitude, when they start saying, well, I'm short, so I have sold all these contracts, and now I'm going to take my profit, I'm going to repurchase those. If you start getting a lot of really heavy buying interest, if everybody runs the races to the door to try and cash in and lock in their profit margins, then we tend to see these price pendulums swing a little bit too far. So they tend to swing a little too far on the downward side, and they can swing a little too far on the upward side, which again, on the upward side, gives farmers some pricing opportunities. So these black bars represent the net long or short position for these, specifically for these money managers. Okay, and this comes from CFTCs, Commodity Futures Trading Corporation. So every week they report on what are the positions for some of these different classes of traders. Now, notice for soybeans, we're at a net short position, meaning there has been a tremendous amount of selling earlier on with the waiting for prices to turn and to go higher before they kind of take their profits. Notice earlier on in 2024, let me zoom in a little bit here, we had the same kind of phenomena. The red line is the futures market for soybeans. Okay, so let me zoom back out a little bit. You can see that there's a pretty strong correlation between these net positions and what happens in the marketplace. Now, what I want to caution everybody, these speculators, these money managers are trend followers. So they're looking at the trends and they're following the trends. They're not trend makers. They're not the ones that cause the bottom on the market, or if prices have been falling, they suddenly turn and go higher. That's usually a fundamental supply-demand condition that does that. But when they see prices falling, like what we've seen in corn and soybeans, they say, oh, there's a trend developing. I'm going to follow, the trend is your friend. I'm going to follow that trend downward. And so they've been taking these positions. They continue to sell, 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 waiting to buy back at a future date. But once they get confirmation that trend has been shifting, then they'll start to offset their position. So thus the pricing pendulum tends to swing a little bit further and faster than we would normally see under other conditions. So my point, what I'm trying to get you to think about, and this is something that farmers are asking about continually, is saying, well, we've seen this downtrend. If we see something change and we see upward movement in the marketplace, what will happen with these investors? Will they change their trading positions? And will we see that rally swing higher and faster than normal? And we're kind of set up for that kind of an environment. So if we were to see, hypothetically, if we were to see some kind of change or shock, or it's like, oh my gosh, we didn't see this coming, that rally, that increase in prices would likely, because of this net short position, be more aggressive. It would likely spike faster, and it may swing a little higher than we would see without these positions. So what I'm cautioning you is, if we do get a rally, it's very likely we will see a pretty rapid, run up in prices, but I don't expect that to last very long, because again, we have this big crop coming in from a fundamental supply position. We're not really worried about running out of soybeans right now. So what does that mean from a marketing standpoint? What does that mean for your marketing plans? And this is kind of the encapsulating everything that we've seen, is if we do see a rally, if we do see a spike, please, please, please take advantage of that. Sell some soybeans. You don't have to sell your whole crop. You don't have to sell, you don't have to, wholesale dump everything that you own. That's not what I'm saying is, but you're going to, this year's marketing plan for both soybeans and corn, we're going to have to look for those pops. We're going to have to look for those rallies and try and sell into those little rallies. So you're going to have to be relatively quick on the trigger. You're going to have a plan in place, and you're going to need some pricing points to say, at this price, I would be willing to sell some more. And for several years, I've been talking a lot about, let me go back to the kind of oops, excuse me. Let me go back here to soybeans, and we're going to pull this back up. We're going to clean this a little bit. Let me delete that stack. Yes. And let me delete this here really quick. Yes. So coming back to this, at what, that's why I like to use these blue bars. That if we get a rally, at what point would you be willing to sell some more? Okay. And again, it depends on what's causing the rally, obviously. But I'm arguing that if you start to, these are going to happen relatively quickly. They're not going to last very long, just because we have, as I said earlier, we're set up for one of these conditions where we have relatively low prices with very little volatility over time. So when you have that pricing opportunity, you're going to have to jump on it. And for a while, for the last several years, I've been really encouraging farmers either to work with a broker, work with your local elevator, work with a processor, and say, um, if prices get to this point, I will sell X amount. So you put the orders in ahead of time. And then when and if the pricing, the futures price, increases and pops to that level, the sales are already booked. You don't get into this mind game of saying, well, is it going to go another 10 cents or is it going to go another 15 cents? And suddenly you miss the sale. So now when you have a little bit of time to do some planning and some plotting, some strategizing, start thinking about where are those pricing points? At what level will you make some additional sales? And at least put in some orders ahead of time to start that process. Because this is going to be, in my opinion, for both corn and beans, one of those years where we're just going to have to keep chewing away at it. We're probably not going to get those nice big rallies and spikes of what we're looking for. We can make big wholesale sales. We're going to have to just keep working at it, keep chipping away at it. So with that, I have theoretically 5 minutes left. I have been able to use up my time. Are there any questions that have come in?
I don't see any, Frayne.
Okay.
And if we have a 10-minute break instead of a 5-minute break, that's okay too. People might
And that's okay too. That's right.
Yeah,
That's right. So, because we are scheduled for a break now before
that's right.
Bill Wilson takes over and starts talking some more about basis.
That's right. Well, maybe that's what we should do, Frayne, is we'll come back at 9:40. So that's in about just over 10 minutes. I see Dr. Wilson's getting queued up here. And we'll come then. And so, Frayne, will you be with us all morning if people have questions?
Yes.
Okay.
Yep, I will be. I'll be hanging on for the whole session. So if there's something that comes up, I'll try and jump in and answer. But I'll be here in the background.
Okay, sounds good. All right, everybody, we'll see you in 10 minutes. Dr. Wilson, if you want to start screen sharing, you should be able to. So, yep, go ahead and start it. I just sent you a note to unmute your mic, Dr. Wilson. I can't hear you. Oh, now you're unmuted.
I have something else on my screen. I got.
Sure, no problem.
I'm going to log back in because I have to move my slide deck.
Yeah, no problem.
How's that look?
That looks good. Just go ahead and start the show. We'll make sure everything looks good then.
How's that?
Perfect.
Am I a model student?
You're a model student. That's great. I'm going to step away for just a couple
Yep.
minutes and
Okay.
we'll start at 9:40.
Yep.
All right, it is 9:40. Bill, are you
Yep,
ready?
I'm
All right.
ready.
So
Ready to
next we
start.
have Dr. Bill Wilson. I'm sure many of you have heard from him before. He's here to talk about the basis situation. And as we know, for soybean farmers in North Dakota, the basis situation has gotten a lot more exciting the last couple of years. We had last harvest, Spiritwood, the green bison processing came online, and then this harvest, we're hearing from North Dakota soybean processors next, they're coming online. So giving more options for the marketing of North Dakota soybeans and for our farmers. So Dr. Wilson's going to talk to us about what we can expect in this harvest of 2024. So with that, Bill, I will hand it over to you.
All right, thank you, Jenna. I put together these slides last week, and of course, things are changing all the time, so I revised them earlier. And some of it's a little complimentary of what Frayne says. Some is redundant, so I'll skip through some, but they'll be complete in the slide deck that Jenna will send out to you. These are the topics I'm going to talk about, and all focused around the bases. Frayne was talking earlier about the stock use ratio, and I just want to highlight these two figures I use in my class. The top one is from NDSU in their extension program. The bottom one is from a trading company. And it shows the inverse relationship between futures prices in soybeans and the stock use ratio. On the right hand, and you can see that it's not a perfect, but it's an inverse nonlinear relationship. It's one of the most common fundamental ways to think about markets. On the right-hand side, I show a history of recent stock use ratios. You can see in 2021, we're 3, going up to 6, 8.4, 24, 25. Frayne was saying was going to be based on last month's estimates at 10.0. At 10.0, that would put futures prices on average in the area of $9 to $10. Now that's striking because we're kind of on a pretty important support level, just above $10 right now. But we have an upcoming crop report, and in the past 2 days, a list on the right-hand side, a company in Europe named Expana was promoting the idea the stock use ratio would be revised upwards to 12.8, and R.J. O'Brien this morning said 12.1. Those are pretty drastic changes. I'm not saying that's going to happen, but that's what people are talking about. That puts futures in the area of $8 to $9. So these are very negative numbers. And when these come out on Monday, I'm sure Frayne will be putting out some talking about this, because ultimately, how we fit on that graph depends in part on what the stock use ratio is. You've seen the slides, and this is September 24. We've been sliding for about a year, trying to find a support level there around $10 and pretty flat on the MACD, as Frayne indicated. Frayne also talked about UCO. This is from R.J. O'Brien 2 days ago, and there's an important piece of legislation called 45Z, and it's the EPA who is investigating this and investigating ultimately the non-compliant aspects of some of the prospective UCO that comes in. They are of the view that if these impediments were eliminated, the futures would be up $1 to $1.50 a bushel. That's their claim from 2 days ago. So news items, a couple days ago, we talk about China wanting to export new crop soybean purchases. We'll talk more about that in a moment. But there's growing concern by handlers in the northern part of this country, including North Dakota, with a very large spring wheat crop. Apparently farmers are buying plastic bags, and this is going to be a hangover in the market, and I'm sure will ultimately affect these spreads. Yesterday, RJO was suggesting that Argentina is looking at slashing their export taxes, which are 30%, which is a pretty big deal on this marketplace. And yesterday morning or 2 days ago, even though China was thought to be buying US soybeans, we're said to be buying Brazilian soybeans. So we won't know that for a while. But these are the developments on the lower slide. It said last night that they bought 4 cargoes of Gulf and 1 at the P&W. Frayne talks about hedge funds. I already had this in my deck, so I'll just comment on it. These are the hedge funds in soybeans, and you'll see the black line. That's the current value, or is middle of July. So compared to all previous years, we're extremely low right now. Here's a long-term picture, same as the one Frayne put up, but there's maybe 2 points I'd add to what Frayne had to say. First of all, this goes back to 2008 on this slide. And those blue bars show the size of the net short positions. And we are record large short. We've never had this large of a net short position in the soybean futures market. That's pretty drastic. And it's been going on since January for lots of reasons. We can talk about those later on, but again, it's been going on. Second point that's important is these are speculators who are short, who don't have an interest in making delivery. So at some point in time, they have to liquidate their short positions, meaning they have to buy. Either they have to buy outright or they have to create a rollover and roll it into another month. That'll create some opportunity in the marketplace. And the third point is that red line, of course, is prices. The correlation between the size of the net short position and futures prices is 0.82. That means 82% of the variability in futures is explained by the position of the hedge funds. That's a big deal. I have a student of mine who's a head trader, one of the major trading companies. When he speaks to my class on this, he said this is one of the most important factors in the market from week to week, and we don't know very much about it. So I think you have to pay attention a lot to that because that'll cause a lot of changes in the market coming up. These are Jenna's figures on exports. The lower one and the black line is exports from the P&W. You can see we've had virtually nil exports in the past few months. And I'm going to say it all depends on Brazil. So we can say that every year, this time of year. Significantly, this shows the production level in Brazil for the last 20 years. Significantly, last year, they produced 155. And looking forward until this week, most traders were looking at a new crop next year for Brazil at 155. But in a news release this morning by one of the consultancies in Brazil, they're projecting 163. That's a huge number. And just that increase of 10 million tons, that's 1 month worth of Chinese imports. And I think you just got to keep a pulse check on that because that'll have certainly an influence on the marketplace. And I don't want to overwhelm you on this, but on January 10th, Robert Lighthizer, who was the STR under Trump in the previous administration, who invented the Chinese strategy, he said on January 10th that the new administration would continue those strategies into a new Trump administration, proposing import taxes on Chinese goods. And recently, as you know, they proposed those upwards to 10 to 60%. This is a huge deal. And part of the negativity in the futures market today, there's no doubt in my mind that part of it is driven by the anticipated Trump administration effects on China and therefore the soybean market. Now, Senator Hawley indicated what was brought to his attention that this would have a negative effect on agriculture. He said we'd take care of agriculture. He said that in December. We'll see, because last time it cost $30 billion, but now China's the biggest importer of soybeans, corn, wheat, and beef cattle. So more than likely it would cost $100 billion to support agriculture. So just as remember that, because when this happened before, and the hedge funds may be looking at this, futures prices went to $8. So that's something to hang over us. I got to talk about the basis. So the word inverted and normal market is really important. The left-hand side here shows futures prices in a normal market situation. The right-hand side says an inverted market situation. A normal market is where we have a positive price spreads between months, providing an incentive to store. An inverted market is where we have a negative price spread, providing a disincentive to store. There's a long, elaborate history behind this, and I don't want to burden you too much, but this graph shows the equilibrium here, where my pointer, if you can see it, that shows an inverted market. And what was transpired in this current crop year is we've moved from an inverted market to a normal market situation, meaning the demand for storage is shifting rightwardsly, and that's what we're seeing in the marketplace. So when I prepared this last week, I created a chart using current futures at that time, and I created the net return to storage looking forward from August. So this depicts an inverted market situation in the nearby, meaning don't store old crop into new crop. because there's a negative return to storage. You know, the low, and I use 6 or 7 cents a bushel per month for storage. I know other people view it should be different than that. That's what I'm using. But in the current chart as of this morning, this is the spread between July 25, that means next July, and November 24, meaning this November. And this is probably the relevant storage period for growers in the Dakotas. And though you can't see these numbers very precisely, back in November, December last year, that value was minus 80 cents, meaning it was a negative return to storage. But since then, it's gone up from minus 80 cents to plus 51 cents. So now it's gone from an inverted market to a very large positive carrying charge market. And that spread represents about 7 cents per bushel per month. And what the market's trying to do is being on that flat part of that supply curve I showed earlier, trying to induce storage from the surplus period in November into the post-surplus period. And in addition to that, we have a positive, so that means we have a positive carry in the futures market, and as I'll describe later, a positive carry in the basis market. My colleague on the board of the Soybean Council, Jim Thompson, articulates that so well when he talks about taking advantage both of the positive carry in the futures and the positive carry in the basis. Okay, so when I talk about the basis, here's the way I depict the markets. We have futures, options, cash. I'm talking about the difference between cash and futures, and that's the basis. That's impacted by lots of things, including rail shipping costs, which I'll talk about in a moment. What's important here is how the basis behaves over time. In concept, we expect the basis to be at extremely low levels at harvest. This basis on the vertical axis, time on the horizontal axis. And in the post-harvest period, the basis appreciates. In theory, it should coincide with that black line, which represents the reduced cost of storage as we move forward in time. More likely and more commonly in the Dakotas, because we have a large multitude of crops that are harvested all at one time, we have a tendency to have heavy farmer selling that has the impact of forcing the basis down to abnormally low levels at harvest time and then increasing more rapidly in the post-harvest period. When it does that, what it's trying to do is induce people not to sell, but to store instead. And what it appreciates rapidly is trying to draw grain out of storage. Now, of course, the grain market for soybeans is changing radically in the coming year, but historically, that price appreciation between the harvest time low and the post-harvest high averaged about $1 a bushel. So it's a serious price appreciation in a very short period of time. I'm sure that's going to change now with the processing plants located. So we use DTN in our trading room. I don't expect you to read this, but this is a basis map of the, I'm going to blow it up in a minute, of soybeans as of yesterday. Here's North Dakota, and I highlight in red, Spiritwood and Casselton. And I'll leave Bill speak to what they're doing. But you can see there the spread between Spiritwood and the neighboring elevators is in the area of 5 to 15 cents a bushel. And there's a similar spread in Casselton relative to neighboring elevators. Ironically, one of my good friends and former students at ADM spoke to my class quite a few years ago before Spiritwood was even invented. And he's talking about Enderlin, and he showed a hand-drawn graph because he didn't know how to run a computer very good. And it showed the spread between their bases at Enderlin and nearby shuttle elevators. And that spread was exactly 15 cents. I'm guessing that's where we're probably going to gravitate towards in our marketplace. So you can see here, this is our domestic market for soybeans. The top line is P&W. You can see, you'll see this in the future as well, but we had very elevated bases back in 2022 at about $3 a bushel. More recently, we've fallen back to about $1.50 a bushel. Highlight that in a moment. So we studied Jamestown traditionally in my class, and anyone who's taken my class probably did a class exercise like this. But these show the seasonal behavior of the bases in Jamestown on the left, and the black line is the average over that time period. On the right-hand side, it shows the same numbers. And what it shows during August, we're typically about 60 under. Ironically, today, at Spiritwood and Jamestown, we're at about exactly equal to our normal basis for this time of the year. We typically have a low that occurs during October, and historically that high basis occurred in January. There's a seasonal high in July and August, but on the right-hand side, you can see that standard deviation in July and August is really, really large. And that's because of the uncertainty about how big and how far forward Brazil carries their exports forward. So we're in a very typical seasonal behavior of the bases at the moment. Here's the same numerical values at Air, North Dakota, with the closest one that's has good data around Casselton. And you can see we're at -70, and that's exactly equal to the historical average. That tells me that people out there must be students of mine, and that's how they're doing this. Maybe I'm bragging, but this is the way we typically analyze the bases. So Portland is our prime market historically, and even for our local crushing plants, they use Portland as a market price. Unfortunately, DTN or AMS does not report P&W basis values anymore. I'll speak to that in a moment. So I get those from a friend of mine at ADM, and these are what they report as the P&W values. You can see they're at about 135, growing at about a nickel a bushel going forward from September. So remember that number 135 with a positive carry of upwards of 15 cents in the basis market, nothing in the nearby. A year ago or 2 years ago, last time we taught so these are his comments to me, but the chart shows what the values were 2 years ago. And 2 years ago, it was 225 versus 135 today. So that's a drastic reduction in the basis. And that's driven really by the fact that there's no P&W demand and there's no evidence that China's escalating their exports yet. That's how important that is. So Brazil's really critical. And what's important about Brazil is their crops are growing larger and they're improving their logistics. This is a long history of the bases in Brazil, Argentina, US P&W, and US Gulf. The green line on top is P&W from 2018 till current. The blue line is Paranagua, no, that's Santos in Brazil. You can see these are kind of highly correlated, but you can see there's a lot more seasonal variability in the Brazilian bases. That's because historically they've had not enough storage and logistical problems. So they get extreme lows at harvest time and extreme highs in the post-harvest period. Now that's mitigating somewhat over time, but not completely. But you can see that all of these bases kind of peaked out at the end of 2022. Our base is at about $3. Since then, we've fallen down to about $1.50. Here's a blow up of that chart for the past few months. And the blue line is soybeans in Santos, Brazil. You can see they've increased from -75 to plus $1.50. So that's a $2.25 increase in the basis. I think anybody can make money storing in that sort of basis appreciation environment. But you can see how now, whereas back in March, April, May, we were completely uncompetitive, our values are now becoming much more competitive because their basis has increased so much. Here's their historical basis. Again, the solid red line shows the historical average over many crop years. You'll see in August, that's exactly 150. That's exactly what the basis is today in Santos, Brazil. So we're in a very typical and normal seasonal behavior of bases. So rail freight values have a big impact on the bases. I'll illustrate these. In part, I think some of you have probably heard me speak about issues of the secondary market and the volatility of the secondary market. I think it's important for you to know and understand the development this current year is the railroads have reduced the number of shuttles that they're allocating for shipping. In the case of BN, I think it went from 155 to 143 trains, about a 10% reduction or more for the current market year. Now, there's lots of gossip about all of this. My opinion is they're expecting reduced exports. There's lots of talk that maybe by having lesser trains in the system, they can operate more efficiently. We'll see. Nevertheless, that's going to be overriding the market. Here's the behavior of the secondary market through 2024, early 2024. You can see pushing about $500 or $600 a car as elevated. The most recent values here are from Mulsum, and I highlight them in October. Look at that bid-ask range. It's 700 to 1400. Historically, the average is 800. So someone's bidding at 700, someone's offering at 1400. And I don't know who's involved here, but I'm only guessing. It's somebody who thinks that there's going to be a lot of bullishness because of short-term accelerated Chinese purchases, and others are probably not reflecting that, but that's a very wide bid-ask spread by historical standards. Here's the same numbers. I highlight them from Trade West. I highlight them in the below. They show October, November, December. The bid-ask spread is 500 to 1200. JFM is 200 to 1000. So there's a lot of uncertainty by shippers about the value of freight in the coming 6 to 12 months. No doubt dependent upon Chinese imports, whether farmers store or not store, and how big is the Brazilian crop. I'm sure those are the factors. The reason why this is significant is the basis values in North Dakota and Portland are impacted by this. Historically, that value called DCV, that's the secondary car market value. We call it daily car value. The P&W basis has a positive correlation, 0.44. The basis in Jamestown minus 0.22. So what that means is if the secondary market goes up, the basis of Portland goes up, the basis of Jamestown goes down, but the basis of Portland goes up by more than the decline in basis in Jamestown. Everything's about China. Frayne's spoken to this. I want to highlight the significance of it. You know, people, for as long as I've been working in this, we've talked about how rapid China's growing and how they're starting to peak out and all this kind of stuff. And Frayne was showing a more recent chart illustrating that. But at the end of the day, the WASDE estimates have them going to 140 by 2030. We'll see. That green line is their imports. This is their current imports as of the other day. And you can see these are from 2010 to 24. And a highlight in the middle there, that kind of, I guess, new blue is the color, circled in red. And that is the most recent estimates. And you can see that their estimates are very strong. Now, lots of reasons for that. My suspicion is they are accelerating their purchases from as many origins as possible in anticipation of what may happen in the post-election environment in the United States. That's my guess. So this is the Soybean Council's chart, so it shows how important China is. And I highlight in here, it's a Thomson Reuters chart on the lower left-hand side, Chinese imports from the United States. You can see that they accelerate very fast in the period. These are shipments, not sales. They accelerate very fast in the period of time, October through January, and then reach a peak. And here's the current values, and these are from Lighthouse from the other day on Saturday. And he highlights these. You can see he's taken my class as well. And he highlights here in white the current pace of exports, saying that we're way behind, way behind recent years. And everyone's kind of waiting till that changes. And I'll speak more to that in just a moment. I keep track of these with a microscope. And because of the significance of these, my most recent values, I do this with another company. And these show the demand projections by month forward and how much China has purchased. And on the far right-hand side, the percentage of coverage. For September, they're estimated, this was as of 10 days ago, October purchases are expected to be 11 million tons. At that time, they'd only bought 200,000 tons. So they still got 10.8 million tons to buy from someplace. So they're only 2% covered. But take a look there as they go into the March, April, May, they've got coverage up in the area of 48% from Brazil. So they're way behind on their nearby purchases and pretty long on their deferred purchases. So either they're anticipating a drastic reduction in prices from the United States or Brazil, at which time they would accelerate their purchases for nearby shipping periods. So that's probably one of the most important things that'll happen in the next 6 to 12 weeks. In my class, I'm going to speak briefly about, let's see our time. When I talk about the issue of bases and futures and different types of contracts, we have a program we use to explore risk and basis and futures and hedging strategies. We use Courtney. I think this is Courtney's, Courtney, North Dakota, nearby Jamestown. On the upper left-hand side, these are current values. It shows the cash price and futures prices both declining. On the lower left-hand side, you can see the basis value is increasing from about minus 160 to about minus 60. So that's a big appreciation. On the upper right-hand side, that's standard deviation. That's how we measure risk. The blue is futures. So the standard deviation of futures has increased, and the standard deviation of the basis has decreased. And the lower right-hand side, you'll find of interest, and this is kind of important, is that most of last year, the futures and cash were inversely correlated. I'm sorry, the futures and bases were inversely correlated, and they're positively correlated. Now they're inversely correlated again. So what does that mean? Futures go down, basis goes up. It's kind of a pretty important concept from marketing strategy. In our program, for a prototypical farmer in the Jamestown area with 50,000 bushels and a production cost of $239,000, we look at the risk of hedging versus not hedging. And that figure that you see there is a probability distribution. Don't worry about it so much. But in the upper right-hand side, it shows the expected bases and futures and the standard deviation of bases and futures. So what that says is the basis standard deviation is 20, futures is 42. So futures is about twice as risky as is the basis. That's what it means. And they're inversely correlated. So if a farmer is 100% hedged, his profits are shown at $242,000. His standard deviation, meaning his risk, is $10,000. If he's 100% unhedged, his profit doesn't change, but his standard deviation of his portfolio or risk doubles, goes up from 10,000 to 22,000. So by hedging, we don't eliminate all of our risk because we've still have basis risk, but in this case, we reduce our risk by about half. We do this every year, and the last time we did it in 2022, and I just want to look at my slides on that just for comparison for you. On the left-hand side is the same exact values, 2022 versus 2024. So take a look at the basis in 2022, and Courtney is minus 255. Today it's minus 68. So the basis is up a lot. Futures were 1610. Today they're 1033. The futures are down a lot. The standard deviations are also shown. That's our measure of risk. And in both cases, the standard deviation is about half, meaning compared to 2022, the basis is up, the futures are down, and the risk is about half of what it used to be. So I'll make a few comments on projections. When we talk about projecting the basis, we talk about, just like Frayne talked about MACD, and he talked about that in the context of futures. And in DTN, we can do exactly the same calculation on the basis. And so this is just for illustration. Actually, this is a program my student created before DTN was doing it. Now DTN's doing it. But it's trying to capture the relative movement of the basis for short-term and nearby as an illustration. So we look at that. So ideally, we would look at Portland, but and I'm kind of telling this to you because I think it's really important. USDA used to routinely report basis values for track Portland forever until 2020, and then they quit doing it in about 2020, and they don't do it anymore. So what does that mean? There's not very much transparency. So marketers, people who are exporters out of the PNW know those values. People who are in the trade know those values. Other people don't know those. I think it's a shame, and I wish hopefully somebody could figure out how to fix that. But in the interim, we have to use surrogates instead of that. So historically, though, this is the P&W basis seasonality. You can see it peaks out here in about July, and then it begins to decline. This exactly coincided with what we talked about earlier, which is the peak of the end of the Brazilian crop and the beginning of our new crop, and how the basis then begins declining through about October, November, and then appreciates. In Kensal, which is around Jamestown, you can see historically they had very high bases back in 21, 22. More recently, we're at about minus 65. So substantially higher than it was a few weeks ago, but lesser than it was a couple of years ago. Here's the new crop basis for Casselton pushing in. I think I can read that number. It's about -85. Pretty solid for new crop for January, from looking from January until current. Here's the same values for Air, North Dakota, good proxy for Casselton at about -70, pretty flat. However, historically, it begins to decline as you go into September, October, November. So when we look at seasonal indexes, this is Air, North Dakota. You can see we peak out in the bases here in about July, August. Then we decline historically and reach a low in October and then increase again. Now, that'll probably soften somewhat now because of the advent of local processing as we embark upon the new crop year. As you balance all this out, this is something I created, I use in my class, and marketing strategies all depend upon how you expect futures to move and how you expect the bases to move. Probably this year, it depends on what happens Monday, but probably a little bit downward pressure on futures prices. And I'm guessing we're going to be seeing upward pressure on basis values as we go through the marketing year. And having said that, probably the better marketing strategies are selling futures and HTAs or buying puts and staying long cash to benefit from the appreciation in the basis. Now, the state of Illinois is taking some of my charts, or I guess this is Brock, and here's their chart in Illinois, shows identify what percentage of the years is the basis the lowest. And I know you can't read this very good, but what it says is the month of September and mostly October are the months where the seasonal low is most likely to occur. So 30% of the time, the lows will occur in October. That's approximately correct for North Dakota as well, though I haven't done it. So in conclusion, we have a lot of risks like we have every year. I know Frayne says we have lesser risk. Yeah, our risk is lesser, but it's still significant. We have in the very nearby months an inversion in the market, which says get rid of your soybeans. And it says also as we go into the more deferred months, probably looking at storing a lot. China is really critical about what they do about coverage, whether or not they take coverage from Brazil or the United States, and how that impacts the P&W basis. At the moment, it's pretty spotty coverage. Most likely, this is just my opinion, I'm guessing, I know people want to be talking about a $10 support or a 10.13 support, what Frayne was showing. My guess is the combination of new crop big Brazil and lack of China selling probably going to put some softening pressure on futures prices, but how much we don't know. I'm guessing there's going to be greater upside on the basis than opposite. I'm guessing we've already seen the inter-month spreads from November to July increase pretty high already, but with a large crop, they probably will increase further to approximate either in the futures market and or basis a full carry to induce storage of the commodity. So with that, Jenna, I'd be happy to try to answer a few questions or comments or elaborate.
I don't see any questions in the chat, Bill. I know you did mention under a new trade administration, what can we expect for North Dakota soybean farmers? And that is something that has been top of mind for those of us that are working for the Soybean Council, that are tasked with trying to be 2 steps ahead of those things and prepare our farmers for what may happen. And so obviously no one knows what may happen, but we have done some work with Dr. Sandro Steinbach in the same department as Bill and Frayne here to give some numbers to what could happen under various trade scenarios for North Dakota soybean farmers, because the last time we did have that trade dispute with China, our farmers were disproportionately affected. So if anyone has questions about that, feel free to reach out to our office, but it's definitely something on our mind and something that we'll continue to engage with. I don't see any questions that have come in. Bill, you're with us the rest of the
Yep.
morning? Okay.
Yep.
So anything that comes of mind later, just go ahead and put that in the chat. Bill, we're about 10 minutes early. Are you ready if we start you a bit early? Bill McBee, I should
Yeah.
say.
Yeah, I was getting off mute there. So yes, I'm here and
Okay,
can start
wonderful.
anytime.
All right, Bill Wilson, if you stop sharing the screen, we'll have Bill McBee get set up with his slides.
If I stopped at that, oh, I see.
You see stop sharing?
There you go.
Yeah,
Yep.
perfect. Okay. All right, Bill McBee, it's and you're good to go. We see your
All
first.
right.
All right,
Right.
so Bill, I'm going to let you mostly introduce yourself, but I just want to tell everyone you are the commercial manager, as we can see, of North Dakota Soybean Processors, the company that is just starting the crush plant in Casselton, just had their ribbon cutting yesterday, so we're getting you really fresh off of that today. So looking forward to an update and what you're watching coming into harvest. So with that, I'll hand it over to you.
Thanks, Jenna, and thanks to the North Dakota Soybean Council for sponsoring this event. Yeah, my voice is a little bit raspy here this morning. We had a big day yesterday with the ribbon cutting in the morning, and had the governor, the Senator Kramer, and several other people there to help us celebrate the event. Anyway, like I said, my name's Bill McBee. I had the good fortune of hiring on with CGB Enterprises out of college. I spent the first half of my career in the grain division, predominantly managing soybean grain facilities throughout the Midwest. The second half of my career, I had the opportunity to join the soybean processing division of CGB, where I predominantly traded soybean oil and learned the soybean processing industry. More recently here in 2023, I took the position as commercial manager for NDSU and moved my wife up to North Dakota, and excited to be part of this great adventure of starting up a new crush plant and really being a part of this. I want to talk a little bit about North Dakota Soybean Processors. I'll talk a little bit about the soybean processing, what steps involved in the products that we make. And then I'll touch upon the economic drivers affecting soybean processing and some of the economic factors that we're looking at. To move. Oh, there we go. So North Dakota Soybean Processors is a joint venture between CGB Enterprises and Minnesota Soybean Processors. Minnesota Soybean Processors was founded in 1999 and is a 2,300 member co-op that owns and operates a soybean processing plant in Brewster, Minnesota. Interestingly enough, Minnesota Soybean Processors actually started exploring the idea of building a crush plant in North Dakota as early as 8 years ago. CGB Enterprises is a company that was founded in 1969, has grown to over 1,800 employees with 113 locations. It's got several divisions, but the largest divisions by far is its grain division. CGB is currently in the top 5 in grain companies, predominantly located along the Inland River system, and is the #1 shipper of grain on that river system. CGB Enterprises also has a soybean processing plant in Mount Vernon, Indiana, that has been around for 27 years. As I said, that's where I got my experience in the processing world. It was probably about 4 years ago that CGB started looking at the idea of expanding our processing division and looking for locations. That's when we approached Minnesota Soy about a joint venture. And then 2 years ago, we broke ground. And in those 2 short years, we've got our plan up and getting ready to get started. So here's a picture of our facility. We're located just west of Casselton. There's a lot of reasons go into picking a site for a processing plant. Obviously, you need a good source of soybeans, and that's kind of what brought Minnesota soy to this area originally, and CGB as well, is the fact that you have a soybean crop that is grown significantly in the last 10 or 15 years, and it is a good place to build a soybean processing plant. The other thing is the logistics, having the transportation modes available. This facility has access to both the BNSF Railroad as well as the Red River Valley Western, or RVW. Both of those railroads give us a logistics advantage to run our business. Also have easy access off of Interstate I-94, so it makes truck traffic into our facility fairly easily. Sorry, I'm having a hard time getting my pictures. There we are. There's a picture, shows Casselton in the background. We started dumping beans in July, and we'll start crushing sometime here in September. We've started some of the commissioning phase of the plant, but after we did the ribbon cutting, we'll get more actively involved in the commissioning phase. And once we get everything up and tested, we can start the plant up. The goal is to kind of work the bugs out here in September and be hitting the ground running hard in October. You can see one of my pointer there shows that's our office. Excuse me, I'm wrong one. This is our office right here. Our merchandising staff and accounting staff are on site there in Casselton. So we will be cutting checks there on site the next day, if not the same day, if producers want to get a check. We'll also have, like I said, people on site that if you want to come in and talk to a merchandiser, we can do that. Or you can give us a call at 701-895-1010, extension 1. You can find that information on our website at ndsoy.com. So anyway, we'll talk a little bit about the soybean processing steps involved to crush a soybean. So when we bring the beans into storage, the first thing we do when we bring them out of storage into the plant is we clean them. We'll run them through a Rotex screener, and we're going to screen out sticks, pods, stems, stones, cell phones, whatever else might be in the soybean that we don't want to process. Then we also have the unders of this, so any weed seed or fines that are in there, those are screened out as well. The next step is to condition the soybeans. We're trying to get it down to a uniform, appropriate moisture and temperature through the conditioning phase. The next we do is called through a jet dryer. It's a heat shock of the bean. What we're trying to do is we're trying to loosen the membrane on the hull, because that's something that's important to get the hull removed from the soybean. And so we put it through the jet dryer, blow hot air on it. The next step is we're going to crack the soybean. We actually run it through 2 sets of crackers that get it down to quarter-size pieces. After that, we run it through a machine that has pipes in it. The beans are going to bounce off those pipes, and it's going to break the hull loose. We actually use air aspiration to pull the hulls. They're real light, to pull the hulls off and separate those from the bean pieces. You can see down the bottom left, the hulls then go to a pellet, or get ground up, go to a pellet mill, and then go into storage. So the bean pieces, they move forward onto the flakers. We have 2 rollers that are rolling at different speeds. As the bean pieces feed in there, they come out as flakes. They're going to be about the size of a cornflake, and the thickness of about 3 sheets of paper. From there, the flakes are conveyed over to the extractor. So the extractor is a big loop chain. You can see below that or in the picture there, that the flakes ride on that chain. And we pour a solvent over the top of the flakes. That solvent is going to actually pull the oil out of them. So then once it runs through the extractor, we've got a mixture of solvent and oil. And we also have a mixture of flakes that have solvent left in them. So the flakes actually go to a machine called a DTDC. It's a dissolvatizer, toaster, dryer, and cooler. So the defaults, it's kind of like a big stir crazy popcorn popper with arms that swing around, and we're going to use steam to help remove the hexane. The hexane has a lower as a boiling point that we flash off. The hexane is recaptured, cooled, and reused. So we desolvatize it, and then we're going to toast it to kill the enzyme in the beans that make it good for animal feed. Both of those steps, we're using steam. And so then we make the meal a little bit wetter. So we got to dry the meal down to the appropriate temperature and then cool it before it goes into storage. The soybean oil, once again, we've got a mixture of hexane or solvent and soybean oil, and we've got to separate those. The solvent has a lower boiling point than the soybean oil, and so we heat it up, flash it off. Goes through a couple stages there. We actually put it under pressure so we can boil at a lower temperature, and then it goes through the last step to get the last bit of hexane out of it. We actually put live steam straight on it and flash off that last bit of solvent. At this point, we've wetted the oil again, so we got to run it through a dryer and dry the oil down. So from there, we end up with crude soybean oil. At our plant in Casselton, we'll have a full refinery. So from the crude oil, it goes into the refinery. We're going to use a centrifuge to spin off the solids. And then it goes through a bleaching phase where we use a bleaching clay to remove the impurities in the oil. And then the last step is a deodorizer, where we use high temperature to burn off any other impurities left in the oil. So when we get done, we get a finished food grade oil product. We refer to it as RBD, refined bleached deodorized. Also, someone commonly knows as salad oil at that point, or kind of like your cooking oil you'd see in the restaurant. And we're selling that into the food industry. So our three products that we end up with is soybean meal, soybean oil, and soy hull pellets. Out of a bushel of soybeans, which is going to be 60 pounds, we get 44 pounds of soybean meal, which is 73%, and that's predominantly used in livestock feed. We get 20% of soybean oil, or about 12 pounds from that bushel, and it's used both in food and industrial applications such as biofuels. And then lastly, the soy hull pellets, we get about 4 pounds, or about 7% of the bean. And that is used, it's a high fiber source. So it's predominantly a hay substitute used in the livestock industry. So I want to talk a little bit about what's going on in the processing world. One of the big things touched on a little bit earlier was that we're seeing expansion in the soybean crushing industry. This is a map here that shows the dark blue dots are all the current existing soybean crushing plants. The light blue dots are the new or considered to be built plants. And then the orange circles they touched on earlier are the plants that are expanding. As you can see, a lot of these plants are in the West. And part of that is because the renewable fuels market is what's driving this crush expansion. And most of that is out in the West, feeding into the California market. We got, let me find my notes here. We have, okay, this past year we had 2 new plants in 23, 2 new plants started up, and then 2 plant expansions. In 2024 here, we've got 4 new plants that are starting up. One started up here a couple of months ago, and then there's 3 of them that'll be starting up here this fall. We expect overall a crush expansion of about 25% capacity from 23 to 2027. So as we touched on, the demand for renewable fuels is what's driving this expansion. This chart here shows the renewable diesel plants. That's where most of the growth is coming from. And the planned expansion in that market. Yeah, we've more than doubled, almost tripled the capacity that's supposed to come along here in 2025. Like I said, California and their low carbon fuel standards program has been a big driver in this. I think California is up to 60% of their diesel is coming from renewable fuel because of their program. We have other states, as Oregon and Washington has joined them, and several other states, Minnesota, New Mexico, and New York, that are considering and looking at low carbon fuel programs as well. On the federal level, you have the RFS, the Renewable Fuel Standard Program, that has been the driver in that. We're looking for, hopeful increase in the mandates on the RFS to help drive this. But the other area that's kind of a potential growth area in this is now looking at sustainable aviation fuel, or SAF. This is an area that has a huge amount of growth potential, and something that is partly, most of these renewable diesel plants can be further modified to make SAF. It's just a matter of whether the economics are there or not. All right, one of the interesting things, as I touched on also earlier, is soybean oil and canola oil are the primary feedstocks for biomass-based diesel, with soybean oil being the largest at 42% and canola at 11%. But there's also other feedstocks that they can use. The yellow grease, or used cooking oil, is the next largest at 21%. It's also considered a low CI, or low carbon intensity. And in some of the programs, the LCFS, it gets a little bit better premiums because of its low carbon status. Also in that area is the distiller's corn oil, which is a byproduct from the ethanol. It's actually spun off from the DDGs, and it's used in the biofuel market. Then you're left with the animal fats, the white grease, tallow, poultry fats, also considered a low CI feedstock, and used in the renewable fuels. So anyway, we've kind of had an impression that as this renewable diesel expansion went, that the availability of used cooking oil and animal fats would be kind of limited in the growth area, and it would come from soybean oil. The one thing that kind of surprised everybody here this past year was the large amount of imports of used cooking oil, predominantly from China. We also saw large imports of tallow from South America. So anyway, there's been a lot of looking in to see, if there was actually something out here this morning. The FDA's, or USDA, is going to start, or excuse me, the EPA, who manages the RFS program, is going to look into those some of those used cooking oil imports to make sure that there's no fraud in that program. So part of that used cooking oil imports has reduced the demand for soybean oil. As touched on earlier, there's been a big drop off in soybean oil prices. This chart kind of is an overlay of soybean oil and the soybean futures, and you can see that they follow each other pretty closely. I think people can make arguments whether it's soybeans following soybean oil, or soybean oil following soybeans, and at times it's both can happen. But I think there's definitely been a strong influence in soybean futures going down because of the lack of demand, reduced demand for soybean oil in the renewable market because of these imports. And we'll touch upon that here a little bit later as far as why that's important, and what's coming up in the some tax credits. I want to touch on the soybean oil market a little bit. As we said, the dark green line there is the food and feed. That is by far the largest category. It's back in the early 2000s when trans fats became an issue. and the hydrogenated soybean oil that was high in trans fats really reduced our domestic food demand for soybean oil. Since that's been kind of worked out of the market, our food demand has stabilized and stayed fairly steady for the last 10 years. As a little bit of variations there, but overall it's been a steady market in that area. The big growth area is in the biofuels, and that's in that orangish line, and you can see the growth there. And then conversely, the exports, we've reduced exports significantly. We never was a big exporter of soybean oil, but it went down to almost nothing. Obviously, with the imported used cooking oil, we've seen an uptick in exports as we get the price down cheap enough that we're starting to export soybean oil once again. The soybean meal market, the highest category there is the domestic animal feed. The biggest user of soybean meal in the animal feed is going to be your poultry, which is your layers and broilers and turkeys. They're going to be somewhere in the 50 to 60% of the soybean meal goes into the poultry market. Next is swine. Swine is also a big user of soybean meal, and they're probably in the 30% range, 30 to 40% range of the use. And then also have beef cattle and dairy that are also used probably in the 10% range of the soybean meal goes into that market. And then there's a small percentage that goes into aquaculture, probably in the 1 to 2%. As far as for human food, we see a little bit of soy protein is used in the human consumption. It's an area that's seeing a lot of interest, a lot of investment, and some growth potential there, but it's a very small percentage of what is used in the market. So I want to touch on what things to look for as we talked about the soybean processing plant expansion. Basically, those plants that are up and running now, we fully expect those to be finished and to start running. There's several plants that have been announced and proposed out 2 years and beyond, and really kind of watching those to see if they continue. We've seen the crush margins definitely drop off as we've seen the demand for soybean oil kind of not be as strong as what was predicted. And so that reduced crush margins could change some plans in that expansion, but something to keep an eye on and watch. Kind of like I said, once somebody starts construction and investing in a plant product or development, pretty well committed at that point. Also looking at the soybean meal exports, as we talked about, if we're going to keep pace with the soybean meal being 75% of the bean, but we're expanding crush because of the oil, that leaves 75% of the product that we got to find a home for. We expect the domestic demand for livestock feed for soybean meal to continue to grow. Historically, it's been about a 2% growth overall. We think that the cheaper soybean meal in the U.S. with this expansion, that we could see that grow to about 3% a year. So if you're thinking about a 25% expansion in crush, domestic demand at a 3% per year growth, theoretically in 8 years, we could match up our domestic demand with this increased crush. But that's going to take time to develop that domestic livestock production. And so in the meantime, we're going to have to look at exports and find more buyers for exports. The key buyers for U.S. soybean meal is Mexico is by far the largest. We also sell a large amount to the Philippines, Canada, several other Asian countries. He mentioned the South Asian, Vietnam is a big buyer of U.S. soybean meal. Our biggest competitors in the soybean meal export market is Argentina and China, Argentina and Brazil. And with Europe being the probably the biggest buyer of soybean meal, and also Indonesia is another big country that imports a lot of soybean meal. So those are two areas that we'll be looking to try to break into that market. I think Brazil and Argentina is like 75%. So there's a pretty big window there of opportunity for U.S. soybean processors. If we get meal down cheap enough that we think we can kind of buy our way into that market. One big thing, Argentina is kind of the one we watch the most, just because such a high percentage of their beans get made into meal. The other thing is the government in Argentina. Some of their policies, and they're dealing with high inflation. So 2 years ago, they had a very small crop, and that really helped us on the soybean meal exports. This past year, they had a almost double-sized soybean crop, and we expected their crush to be significantly higher. It has increased, but not as much as we thought. And part of that is the Argentine farmers have learned to use the silage bags, the white bags to store beans as a hedge against inflation. I was just looking up here earlier. Argentine inflation is back up above triple digit again. We talk about inflation here in the U.S. and how high it is, and can't imagine what it's like to deal with triple digit inflation. So anyway, their farmers have held on to more beans than thought, so their crush hasn't been quite as high. So we'll have to see what happens moving forward, but there's a fair amount of beans there that have to move yet. The 45Z tax credit, this is something you probably may not be aware of or heard about, but it's really big in the biofuel market. In the past, there was a blender's tax credit that was used for the biofuel produce blenders who would buy biofuel and blend it with diesel. We get the tax credit. The 45Z, the one thing I do like about it is it converts it to a producer tax credit. So in the past, biofuels coming from foreign countries could come in, the person blending it didn't matter where it came from, person blended it could get the tax credit. Switching to a producer tax credit, it has to be produced in the U.S. to receive the credit. Unfortunately, they didn't make any stipulation on the feedstock. And so that's why we're seeing all the imported feedstock will still keep coming in. So he mentioned NOPA, the National Oilseed Processors Association, which North Dakota soybean processors will be a member of once we get started. NOPA has been working with the American Soybean Association and trying to work and get some legislation pushed through that will make the tax credit only eligible for biofuel produced with U.S. origin feedstock. So anyway, that's pretty important. Hopefully we'll see that go through here. Couple other notes on the tax credit that I think something you guys want to keep an eye on and think about is there was some introduction of climate smart ag. Climate smart ag is requiring for the biofuel producer to get a higher credit. They have to buy crops produced with climate smart ag practices. For soybeans, this is going to include no-till farming, planting, and also a cover crop, a non-harvested cover crop. For corn, the tax credit will be available for ethanol, but corn for the climate smart ag also throws in the reduced it's fertilizer usage, more economical or safer fertilizer usage. I'm not exactly versed on that, but that's also something that they'll need all three of that. So we're also, I mean, they've kind of laid out the guidelines for 45Z. There's been some comment periods, people trying to expand the different types of farming practices that are allowed. We'll see the U.S. Treasury Department is the one actually that will be making the final decision on this because it's a tax credit. And so be interesting to see what they want and when they come up with the final decision. There's promise that they'll have something out by November 1st. This tax credit is supposed to take effect in January of 25 and run through year 27, so a 3-year program. But if we're going to start in January, people are anxious to see what that is and what that final ruling is going to be. One final thought I have or comment, at the price levels we're at, it is a challenging to know what to do with the beans and where to market it. So I fully agree that having offers out there, so if there is a something in the market that creates a bounce, I think it's good to have that out there, because I don't think they're going to last long. There's a fair amount of inventory that needs to be priced. As far as new crop, we're really low on what we've seen, and what CGB is a large grain company is at record lows for new crop purchases, which tells us that there's a lot of soybeans out there to be sold. The other thing is we're looking at some pretty strong carries. As I mentioned before, we're trying to incentivize farmers to hold beans into the summer months. As a crush plant that runs 24/7 year round, we're going to need beans not only in the fall, but we're also going to need them in the summer months as well. And so trying to find ways to encourage guys to hold beans. Putting carry in the market is obviously the most easiest way to do that, and hopefully people are taking a look at that and thinking about that in their mix. One of the things, you know, in marketing that we are a strong proponent of too is working on averages. You're not going to hit the high, and that's really not what your goal is. Your goal is to, if you see a rally in the market, take advantage of it, but continue to sell a little bit along the way. One other thing that's kind of good to look at is a min-max type contract with options. We like the min-max part of it because it reduces, having the max side of it does allow you to reduce that cost of the options a little bit. It limits your upside, but we think with the amount of inventories out there that the upside is kind of limited anyway. So anyway, it's something to take a look at and think about. North Dakota Soybean Processors is using all the contract options that CGB had, as well as their app that they use. We've rebranded for North Dakota Soybean Processors. And so really think that's an advantage that we have that you might want to take a look at. And if you want, like I said, call one of our merchandisers and discuss those if you have any questions or interest in that. So anyway, thanks for having me here, and that completes my presentation.
Thank you, Bill. I think you did a great job at explaining the whole process to us and the issues that you all are looking at as processors. I think every speaker we've had today has talked about used cooking oil. And so it's definitely something that is on the mind of everyone watching soybean markets. And you know, I think it was explained, but if anyone watching isn't aware, used cooking oil is a feedstock for biodiesel and renewable diesel. And in the California market, which is where an awful lot of the renewable diesel is going to, they incentivize using used cooking oil instead of soybean oil by changing the price that they're willing to pay. And so if we're bringing in used cooking oil from overseas, we're using less of the soybean farmers' soybean oil here. So that is an issue that is top of mind. For us at Soybean Council, I know our Growers Association is keeping a close eye on that as well, because it's a big deal to those people that are in the industry trying to work.
It definitely has an impact on our prices, and so something that hopefully we can do something about.
Absolutely. Sounds like they're trying, right?
Yeah.
So,
Yeah. Nothing moves fast in Congress, so it takes time.
That's right. That's exactly right. Well, I don't see any questions in the chat, Bill. Are you hanging with us for the weather update?
Yes, I will.
Okay, wonderful. So again, all of our speakers are with us all day. So if anything comes up, we'll do a final call for questions at the end. But if anyone has questions about Casselton or delivering to Casselton, do you want to give them one more reminder of where they can go to get those answered?
Sure. ndsoy.com is our website. and our phone numbers on there, 701-895-1010, extension 1. We'll get our merchandising team.
Great. And do you all have an email list that you send to with kind of updates, or is it mostly text?
Mostly text is
Okay.
what we're looking off of.
That's good. That's good for me to know, because when I get questions, I like to tell people where to go. So that's good for me to know. Sign up for texts for Casselton. All right. Well, we have 5 minutes ahead of time again, so I think we'll take a 10-minute break and we'll start at 11. Mark Ewens, are you ready to go at 11? I think you will be.
If I unmute myself, I can actually answer yes.
There you go. I had faith in you. So we'll be ready to go at 11 with our weather update from Mark Ewens. So if everyone wants to take a break for 10 minutes, we'll pick up then and we'll see you then. And Mark, if you want to, let's see, Bill McBee, I'll have you stop sharing your slides. And then Mark can start sharing his.
Says I'm sharing my screen. Can you see me?
I can see it, but you'll want to go to that display settings at the top and swap. There you go.
Yep.
And then swap your view. There you go.
Oop.
Awesome.
Of course.
Good.
Let's try that again. Come on.
Oh, we got the right view this time. We have like some, I think it's probably, yeah, it's going away. I think it's like a weird hashed gray area where it's like your Zoom toolbar and your participant view. So if you can take your participant view and make it go down to like one picture or no pictures. That's weird that it's doing that.
Let's see. Does that do it or?
Yeah, it's still there, but it's a lot smaller now. I don't know. I've never seen that happen before in Zoom.
I just put it over in the corner.
That'll work. Yeah, then we can see it's still there, but we can see, yeah, that's even better. We can see almost all of it, so that'll work.
Jeez Louise, come on. You know, me and technology, we used to be friends.
It's always something new, is what it is. So. All right, I'll just do a brief introduction right before 11, Mark, and
Very good.
Sounds good.
Thank you.
All right. I think we'll start to get back here. We're in the final stretch of the mid-season market outlook. We have our weather update. I know we've talked a lot about markets and what we can expect there, but we all know that at the end of the day, markets will respond to the weather as well. And so Mark Ewens is going to talk to us about the trends that he sees coming into harvest. Mark is the staff meteorologist at KNOX in Grand Forks. Prior to that, he spent a while working for the National Weather Service. And beyond that, Mark, I'm going to let you give a little introduction before you start your presentation, and I will hand it over to you.
All right, Jenna, thank you very much. And thank you all for asking me to be here today. I think this is, I don't know, I've done several of these, so I do appreciate that you keep asking me back. Prior to my weather service career, I was in the Air Force for 10 years in weather. That is how I got my start with the National Weather Service. We were actually transferred to Fargo in 1979 when the Air National Guard unit was a part of NORAD. And I was coming up to my third reenlistment in the military. And at the time, the meteorologist in charge at the Fargo office, Herb Munson, said, "Hey, how'd you like to work for the federal side?" And it was a kind of a tough decision, but I went ahead and bought my military time back, rolled it over into my federal time, and did another 32 years with the Weather Service. So all in all, I've had a pretty good run. Now I'm in retirement, was picked up by KNOX a couple of months after I retired. I just can't seem to get out of it, but I consider myself one of the fortunate ones for what I do as a hobby. All right, you know, for those of you who can do your hobby for your career, and that's what I've been fortunate to do, is my hobby has been my career. Doesn't mean I don't take it seriously, but it's just been, I've been very, very, very fortunate. So without any further ado, let's move forward here. Now, data by division, for those of you who have heard me give my talks before, just kind of a thumbnail of how the National Weather Service and most of the climate community looks at data. These are the climate divisions. Every state in the United States has 9 individual climate divisions, Minnesota and North Dakota displayed here. These approximate homogeneous weather conditions over a long enough period of time to be considered normal. But we know that, for example, in Climate Division 3 of North Dakota, the weather in Thompson in southeastern Grand Forks County can be very different from the weather in Candu up in Towner County on any given day. But over a long period of time, we look at this and say, this is climate. So I do these presentations with that in mind. Now, this is the aggregate annual Red River Basin temperature. Now, these are North Dakota climate divisions from the previous maps, 3, 6, 9, and Minnesota 1 and 4, so a fairly large area. The aggregate annual temperature patterns over the history that we have reliable weather data, so approximately 123 years from 1895 until 2023. And you can see the thick red line is each individual year. Weather is very noisy, significant variations from one year to the next overall. The slightly thicker blue line is the 7-year running mean, which is kind of a climatological standard number to use, 7 years. And then the thinner black line is a polynomial smooth variance of the temperature. And you can see we rose a little bit coming out of the cold, wet period of the late 1900s into the early part of the previous century. And for a lot of us who are of a certain age, we grew up in a period of time where the weather was relatively stable. That's where the line is fairly flat from the 30s into the 70s. Then, of course, we've seen the warming that has commenced over the last several decades. And recently, in the last roughly decade, 15 years, there has been another relatively pronounced flattening of the temperature pattern. This, same with precipitation, the wide variations from one year to the next across the climate divisions. That's very typical. Obviously, thunderstorms give a significant variation, but even as do snowstorms. The purpose of all this is to show that there is significant noise within the climate system naturally. Now, the alphabet soup Again, this is something I like to show because as we have matured as climatologists, we've come to understand some, not all, some of the driving factors behind the climate. So the alphabet soup includes what most of us are familiar with, the ENSO, the El Nino Southern Oscillation, La Nina, El Nino. There's also in the Atlantic multi-decadal oscillation, in the Pacific decadal oscillation, so forth and so on. Many different signals that we've come to understand that affect the climate. And as the water temperatures change up and down, that causes the climate to change. We've also really learned a lot about the AO, the Arctic oscillation, and how that is being impacted by the changing Arctic. So this is just the most recent alphabet soup map, all the letters removed. This is the sea surface temperature anomalies as of just a couple of days ago, showing, and this is all derived from satellite. That's the other beauty, is the satellite technology has enhanced the buoy technology, which has become very robust. So we have a much clearer picture of what is happening in near real time. So across the Pacific Ocean, here is the ENSO region. These wave-looking signatures of colder than average water progress from the upwelling near the South American coast and move to the west. This is the signal that shows us that we're making a fairly rapid transition, rapid in climate terms, from last winter's moderate El Nino to what is forecast to be a weak to moderate La Nina. That right there throws a tremendous amount of variability into the atmosphere. For those of you who have been keeping track, we had essentially 2.5 La Ninas in a row, a very robust El Nino. Now we're switching back to a La Nina. For those of us who grew up in the neighborhoods that had the big circular pool that one of the kids had, the large ones, and the fun thing to do is to get in that pool and get it going in one direction and then stop and try to go against the tide, that turbulence that would develop, that's what we're seeing in the atmosphere as a result of the rapid changes within the oceanic system that have been occurring over the course of the last year. So again, from the 2023-24 winter to where we're headed in the 24 to 25 winter, big changes as the very mature moderate El Nino is changing ENSO neutral and on its way down to a La Nina. The forecast models give us a 70% chance. Now I'll pause right there because for many, many years, we have tied the El Nino La Nina cycle to the weather in the northern plains. And with a modicum of accuracy, we've been able to say, and I think everybody is, or most everybody is familiar with La Nina associated with cold and snowy, El Nino associated with dry and warmer. Again, 70% of the time. It's that 30% that we never could quite figure out what was going on. Now, with the complete picture of what is happening in the Pacific, Atlantic, Indian Ocean, other basins, we now start to have an idea of the extraordinarily complex changes that are occurring across all the ocean basins, sometimes working in concert, sometimes working destructively against one another. Now, these images, starting from the upper left-hand corner here, this is the climate forecast system forecast of the cooling over here to, this is August, September, October in the upper left. Upper right is October, November, December. November, December, January 24, 25, down to January, February, March of 25 in the lower right. So these are seasonal sequences from the climate forecast system, the NOAA model, and it's gotten far more accurate over the years. And I use the term accurate rather liberally when it comes to forecasting the climate. But the model has done a much better job as the sensing of the oceans have improved. So another interesting thing, for those of you who remember that horribly fun movie, The Day After Tomorrow, looking here in the lower right-hand corner, you see a little cooling in the North Atlantic. Perhaps you've heard of the slowing down of the Atlantic multi-decadal oscillation. There are several different names that it goes by. So these are unknown changes that are occurring, or I should say, really indescribable changes, what will happen to the atmosphere. While the physics behind the movie The Day After Tomorrow are actually relatively accurate, The time scale of all of that happening in a couple of days or weeks, pure nonsense. But there are many changes occurring in the ocean systems. And since they're starting to show up locally, and I say locally on a time scale, we have an idea that we might see some more noise in the climate system than we've been used to. History is also a guide. I see a lot of historical data being used in trends when it comes to talking about the different agricultural influences. The graphic on the left is the April to September, or what we would call the warm. Did I flip these? I believe I did. So from April to September, during that period, the warm season, that shows temperatures have generally cooled oh so slightly. This is an overall from 1990 to 2020, subtracting 1970 to 1990. So taking those two decadal periods apart, we see there's actually been a general cooling that has occurred through a large section of the plains. So that's something that we key on what is going on. The October through March winter seasons have warmed relatively dramatically in some parts of the country, relatively slower through the plains. Now, this is just to zoom into the previous graphic where we can see that there's been a fairly large area of relative cooling in the warm season. So we're not seeing as many 100-degree highs as we used to see. We're not seeing as many sustained heat waves as we used to see. And of course, we'll blame agriculture because agriculture affects everything, right? To a degree, the increased relative humidity that's being put into the atmosphere by some agricultural processes is a part of the process. But there are far more larger macro scale changes in the biosphere that are going on apart from agriculture that are increasing humidity. And I'll get to one of those shortly. Same thing with precipitation. The left-hand panel shows how there has been a rather significant increase in summertime precipitation over the last several decades, and a modest increase during the cool season as well, with drying, generally speaking, in parts of the Central Plains agricultural areas. But overall, I think you know that we've seen a few more snowier winters and wetter falls than a lot of us grew up expecting. Just another way of looking at the data, starting to boil it down to local points. The upper left-hand graph shows the 1987 historical data. What I do is I look at all the ocean atmospheric signals, determine what years this year looks like historically, pull a select number of years out, and that's the basis for making climate outlooks. So I can start to say, okay, I then plot the temperature and precipitation patterns between the two and start looking for analog years that describe the atmospheric's response to the oceanic inputs. So these are time-tested techniques that have been used for a very long time in making climate outlooks. Obviously, climate is large scale, weather is small scale. So we're going to see those variances that are presently difficult to really define. That's where we get into the weather forecasting models, which typically go out 16 days in advance, and even those have gotten better. So again, this is all large scale stuff. So these are two examples of past weather that can be used as a guide as we've changed temperature patterns from 97, 98, and 15, 16 El Nino winters are pretty good signals as to what may be happening in the upcoming winter season. So keep that in mind. If you can think of also the 88, 89 winter is another one that has similarities to it, as does the 2016, 17. So there are several winters, falls and winter seasons that are trending the way that those summers have gone. So you keep that in mind for what we might be looking at for an upcoming winter. And quickly, something else I've been toying with, and this is just kind of an experiment I'm working on from the agricultural standpoint, is developing some growing degree units based forecasts based on the same technique by looking at previous climates and then running some numbers out. So far, and the graphic in the lower left side of the screen shows the different years. So there's a pretty big spread, a little too big of a spread to really make it an operationally viable tool. So I'm working on that. The red line indicates the mean. The black line indicates the observed. So from the standpoint of the way that the model was forecasting, looks like the growing degree days actually met the mean model forecast relatively well. So I was shocked, quite honestly, when something works out so well in the climate realm. So it gives me some encouragement that at some point I might be able to actually make some GDU forecasts as well. We've talked about the soil moisture. I've heard several people talk about that. This is another view. This is from the NASA USGS Veggie Dry system. This is available online, and I'll be able to supply URLs to folks if you're interested. This data are updated weekly. This is the latest information I could pull down from the web from the 20th of July to the 4th of August. And no surprise, where did all the rains fall this past spring and summer? So you can see how they're extraordinarily wet over northern Iowa, southern Minnesota, and up into the Red River Valley region. Same basic principle as I heard being discussed, that it's based on the satellites. The greener, the more robust, the more water, and the browner, the drier, the less water available. Now, this one is a calculated soil moisture based on those inputs from the Climate Division. This is a soil moisture profile. I believe this one is the top 5 centimeters, so a fairly shallow, basically skin layer that they look at. And this is something that is a 30-day running average, and this is updated roughly daily, but it lags several days behind. So these are just systems that you can look at, data that you can look at to give you an idea of the relative soil moisture over parts of the region. Now, the climate forecast system also makes soil moisture outlooks. And in the upper left here, this is the August, September, and October soil moisture outlooks, and it shows that soil moisture remaining very high in southern Minnesota, into much of Minnesota itself, and into the northern parts of the Red River Valley. And the lower right is October, November, December, getting into freeze up, but the soil moisture is very slow to go away. So this would suggest going into the start of next growing season with sufficient soil moisture. Suggests. It also indicates that obviously folks who are very wet right now are going to continue to be very wet. And another one is the 12-month standardized precipitation index drought forecasts. The Climate Prediction Center puts these out for several months in advance. In this case, it's August, September, and October. Basically, this really focuses on drought, not on relative wetness. But by these indicators, from what we'd seen, the previously thought about drought that a lot of us were thinking in the spring might become a problem. Obviously, Mother Nature said, nope, now we're more than wet. Drought in the western parts of the U.S. will remain. So this is something that can be done. The SPI, if you're not familiar with it, is simply a long-term value of total precipitation against climatology. And it is one of the many tools that are starting to replace the old Palmer Drought Severity Index, which many of us grew up with. Drought outlooks, I think everybody's probably familiar with the USDM and the monthly and seasonal outlooks that are available. I heard Frayne talking about it. These are relatively generic tools in the sense that they have human input along with the man-machine mix. Boy, there's an old term that is used to analyze the relative drought intensity. And it's meant to be a macro scale picture. Conditions obviously vary from field to field, state to state, so forth and so on. Okay, the climate recap so far this spring and summer. Real quickly, obviously it has been very wet. This is the April 1st through the end of June precipitation totals, courtesy of the NOAA Regional Climate Center down in Lincoln. Precipitation on the mid left, right, the mid upper left is the departure from normal temperatures. And that shows how it's been relatively warm over a large portion of the growing areas of the central into the northern plains, spots of cooler weather, the Dakotas back to the northwestern US. I have some family in Utah. They say that they've had a pretty wet summer overall in that parts of the area. And some of the lakes are getting back to the point where they were prior to their mega drought, which has come to an end. In the lower half of the graphic, this is the composite analog outlooks for the same time period, and shows that, well, okay, they didn't necessarily do so well because there's a change in the climate system I'll be talking about shortly. In some ways, they They have some places where they did okay, but most notably, the extraordinary wetness that occurred in southern Minnesota, northern Iowa, the composite analog suggested very dry. How'd that work out? Unfortunately, not well at all. So when this happens within the climate system, I go, okay, there's something else going on that I was unaware of. Well, what that was, again, get to momentarily. Just to zoom in, data from the North Central Regional Climate Center in Lincoln, just showing how extraordinarily wet. Everybody knows how wet it's been down in that part of the world. And of course, temperatures have been near normal, as we say in the climate realm, pockets of cool. A lot of this is from NDON data as well, along with the National Weather Service Cooperative Network. So it's a relatively high resolution graph. Okay, now the unanticipated surge. This is what really has thrown the climate system into a loop. January the 15th of 2022, maybe you've heard about the Hunga Tonga volcano that erupted. It's 20 degrees, 0.55 degrees south latitude, 175.385 west longitude. So it's located well east of Australia in the middle of the Pacific. It's a wild card that I didn't necessarily pay close enough attention to. I'd heard about the volcano, but didn't fully understand its impacts. The volcano sent, and yeah, this number is just, it's meaningless to us. 146 teragrams, that's 146 trillion grams of water into the atmosphere. That is an unknown player in the entire climate system, because within the recorded instrumental history, we've not seen this much water vapor being injected at one time into the atmosphere. And not just the stratosphere, but it's made its way into the troposphere as well. Reverse that. We live in the tropopause. It's made its way into the next layer up. And when you put water vapor up into the stratosphere, that is a phenomenal warming gas. So the water vapor in the stratosphere is an incredible heat trapping gas. And that significant water vapor is going to stay there for a very long time. So it's the biggest increase that scientists have said. Here's a fancy little loop of the actual volcano when it went off January the 15th in 2022, considered to be the most powerful explosion on Earth in more than 30 years. 100 Hiroshima bombs is what they calculated. The shock wave literally ran around the globe a couple of times, I'm told, and the plume of ash and dust reached higher into the atmosphere than any other eruption on record. 590,000 lightning strikes in 3 days. On the left-hand side, right quickly, this is a graph of the precipitable water in the atmosphere. And that precipitable water was gradually going up. As the atmosphere warms, its capacity to hold water vapor increases. The big jump that occurred because of the volcano, this is the northern hemisphere. Interestingly, the southern hemisphere precipitable water was actually going down and has gone up as well. Temperatures basically had been relatively flatlined in the last decade or so, and they've shown an increase again because of that volcano. Now, having said all that, these are then calculated and factored into the climate outlooks. So here's the official August through September outlooks. I'm using the probability of exceedance to give you an idea of how much confidence the Climate Prediction Center and because I tend to agree with these particular outlooks. So the one side, the left side, is the anomaly temperature. The right side is the anomaly in inches. And it shows for the general August, September, October time period that we're in the Red River Valley and much of Minnesota, near normal temperatures for what that's worth. Drier than normal, should start to overtake the central plains into parts of southern Minnesota with normal precipitation for us. I'll go through these relatively quickly. Same scenario for September, October, November. Very warm through the Intermountain West, drier in the central and southern plains, neutral. So normal precipitation patterns are expected in the Red River Valley from the CD's Climate Prediction Center. We start to see a little cold showing up in the October, November, December in northern Montana as we get into the late fall, beginning of the meteorological winter. And then the start of the meteorological winter, December, January, February, 24, 25. For a La Nina and for what's supposed to be a fairly robust La Nina, we're not seeing a lot of cold expected to be across the northern plains as we get into the winter months. And precipitation, we'll see the increase in the Ohio Valley, which is fairly common, but not necessarily a lot of additional precipitation through the Red River Valley or much of the northern plains. A normal snowfall winter is what is forecast. Finally, March, April, May, jumping ahead into next spring, the colder weather lingers, normal temperatures, precipitation still in the upper Mississippi Valley parts of the Ohio Valley above normal, drier than normal in the Four Corners region. Now, these are the composite analogs based on my La Nina to El Nino post 79 kind of transitions. And that shows us for being August should have been relatively warm, and precipitation wise looks like we should be relatively wet. We're kind of seeing that verify a little bit. And then the August to October in the lower left, again, a continued warm pattern with above normal precipitation over much of the tri-states region, especially in that southern Minnesota. So this is a little at odds with what the CPC data are showing. And then looking ahead, this is October through March. So this is the broad-based winter outlook. The left-hand panel is the temperature anomalies. Looks like about a normal temperature pattern this winter. Again, the injection of all the moisture from the volcano has modified the way the atmosphere should respond. Precipitation, perhaps a slight bias to the high side of normal, but not looking for major snowfall increases like we've seen in some recent years. I know there are some private vendors that have gone out and said, we're going to have a brutally cold and extraordinarily snowy winter. At the moment, I don't quite agree with that. And then right quickly, some temperature outlooks from the international climate community. There's a forecast model that they run showing warmer than average temperatures over much of Bolivia, Brazil, Paraguay, Uruguay, on up into the Venezuela region, below normal precipitation along the equatorial regions. October, November, December, shrinkage of the warmer weather in South America, dry weather still along and just south of the equator, getting into their meteorological summer, looking for relatively normal temperature pattern over much of South America, wetter near the equatorial regions north, drier along the equatorial regions. Freeze frost data, real quickly, this is from the National Weather Service Grand Forks website. This page shows where you can look at average freeze frost information supplied by the National Weather Service and the Regional High Plains Climate Center. So if this is something you're curious about, select points in the Red River Valley region and points east and west, these are where there's long-term historical climate stations available. So the recent updated research suggesting that significant changes to the overall climate due to the 2022 Pacific volcano eruption. I think precipitation will most likely be a little higher than normal climatology in many areas due to the increase in moisture. But again, a new normal is emerging, so we don't have a handle on it yet. And despite the forecast of the moderate El Nino this winter, the increase in atmospheric moisture will probably offset the more classic cool ENSO signals. So I think kind of a normal winter from the temperature standpoint, colder west, a little warmer east. So I don't look for a big heavy snowfall. Generally in the valley, we're talking then in that 40 to 50 inch range. That value obviously varies from place to place depending on how the systems actually pan out. So, and one last bit, if you're interested, some of the emerging research from a Dr. Judah Cohen of the Atmospheric Environmental Research Facility, he's up in New England. He has done some groundbreaking work with the Arctic Oscillation and forecasting climate over the North America region, and he's gotten pretty good at it. So again, this is all available online. I know I zipped through a lot of stuff real quickly. Oh, also forecast accuracy for near-term forecasts. This is from a group called Forecast Advisor, the Weather Channel, AccuWeather, and Vaisala, which is a big weather instrument company, have the most accurate forecasts on average. The poor National Weather Service is down kind of in the middle of the bunch with about a 60% accuracy rate. So the Weather Channel score is really high because they've been using artificial intelligence in their modeling for quite some time. I know I ran out of time, kind of zipped through that really quickly. I'd be happy to answer any questions. Otherwise, I believe the presentation's online and my email address is available if you wish to communicate. So again, thank you. allowing me to be here. Lots of stuff out there, and I'll turn it back over to you, Jenna.
Yes, thanks, Mark. Thank you for including that South American climate update as well. Something that we as soybean farmers keep a close eye on. So thank you. I like the idea of a winter with not tons and tons and tons of snow. That doesn't sound bad to me. But hopefully coming into harvest, as you said, we'll have some warmer temperatures for some time. Hopefully can avoid that early frost. And as long as it's not enough precipitation to keep us out of the field, then we'll be happy. So
yeah.
Thanks
Thank
so much. Yes. So last call, I've been watching the chat for any questions for any of our speakers. They're still online here. I just want to thank everybody for joining us today. This is something we've done in this format. This would be the, I have to think exactly of when in 2020 that started, but probably the 3rd year we've done this, maybe 4th year online. And so if you have any feedback on timing or availability or topics or anything, please email me. You should have my emails because I emailed all of you the link to join this. So happy to take that. But I just want to say thank you to our speakers. I think this information is very helpful. And by the number of people that have asked me if we're recording and how they can get the recording, I think the attendees agree that this is important information to have. So with that, I think I'm going to close out the meeting here. I will be working on getting slides and the recording available to all of you. So watch your emails in the coming days for that. So thank you again. Please do remember that events like this are funded with your soybean checkoff dollars. And so we thank you and appreciate that you're taking advantage of these opportunities. Have a great weekend.
Thank you, Jenna.
Thank you.